Friday.
I was going to say, what is the read-through on the banks front? Do we start to see some sort of reaction to the banks session that we saw there? But also the yields picture, right? Because if we're waiting for that flight of safety to show up, does that bring that kind of peak margin story forward?
Yields are higher this morning, not by much, but a little bit. So that's what we're certainly seeing into govies this morning. That is a trade that we're going to be watching out for. Be interesting to see kind of what Goldman says and how that reads into banks like Barclays, maybe here in Europe. Maybe that's where the translation comes through. Anyway, European markets are open. We're going to first look at what's happening with the FTSE this morning. There's an oil trade in there which may get unwound. So Shell is a big component part, obviously, of the FTSE 100. And it's likely maybe to see some of that gain that we saw Friday being unwound. But broadly, I think probably the kind of the macro top-down picture is going to be one of relief. So initially it's ASML doing well, LVMH is out of the gate looking strong as well. Safran and Airbus on the aerospace side both trading strongly as well. And as I say, Shell and BP and Astra actually the biggest points drag on the European market, which translates into an underperformance going through from London.
Yeah, I think the mining story is again really interesting. Your biggest index contributor this morning is going to be Rio Tinto, which is fascinating. As is, and you have of course that defense bid going into as well. BAE Systems is trading higher. To me, the airline space is interesting as well. Given that so much of the kind of shut down airspace in the Middle East from these conflicts, you are already, from the last time we had gone through this kind of iteration, seeing a lot of airlines come out and say that part and that conflict there actually ate into their bottom line. Ryanair, for example, was one of them that had spoken about it.
So there's a number of different ways you can look at this, one of which is you can't fly, it's more difficult to fly to the region. And then there's another story which is more difficult to fly across the region. It's the latter story which is becoming increasingly problematic for European carriers. There's a very small corridor that you can now effectively fly through if you want to go out east, and that now is a huge benefit for carriers like Emirates, who can fly over Russia, who have greater access to the region in terms of airspace. There was quite a significant shutdown of airspace this weekend as well. So this is there is a European airline story that I think is going to be one to watch out for. It's been getting worse and worse and worse, and higher oil prices also don't help.
That 100%. You're also, again, going back to kind of that aerospace story. If you look at some of your top 5 movers to the point, you've got Airbus moving higher. The defense companies I'm going to keep bringing it back to because you see that kind of seeping in. Rolls-Royce, for example, one of your biggest index contributors this morning on the FTSE 100. But you're also, I think, still seeing a bit into some of the banks as well. We talked about this, whether or not there'd be this read-through given that some of the U.S. banks are reporting. You have Lloyd's, Barclays also significantly higher coming out. And even Standard Chartered is seeing some pretty decent high volume, although only up 0.3%, but it looks like enough trades going in there to make a little bit of a difference.
Some of the metals companies are gaining, so it's interesting. Norsk Hydro is gaining. That's a big aluminium producer here in Europe. So in theory, Russian supply, which had been coming in, will no longer be coming in. So that, in terms of higher prices, will benefit them. It was interesting listening to Will Kennedy talking about this earlier. What we saw in the oil market was a kind of rewiring of the global oil markets. Supply that used to go over there now goes over here, and supply that used to be over there now comes over here. You get that rewiring effect, and a lot of the metals will just simply get rerouted back over to China, but potentially at a discount, which will be really interesting as well to see whether that suppresses prices more broadly.
But you know what all that volatility creates a tailwind for is a company like Glencore, which again is also seeing a big tailwind this morning. All that though having implications for the inflationary story in the longer term, right? If you see sustained volatility or sustained bump, not only in the oil story, but in some of these kind of raw materials like aluminum, nickel, etc. Well, we talked about this in the last couple of weeks. Those are the main raw materials you need for the defense sector as well. So suddenly you have this big demand story.
And then you've got to look at the inflation implications. I think that's what everybody's watching so carefully. I said the conflict this weekend weekend, what's happening with the metal story, how inflationary will ultimately some of this be?
Inflationary, and therefore, what do the central banks do? How far are they looking? Well, we got a little bit of sound to play, a little bit of takes from the Fed's Daily and Collins. Take a listen to what they had to say when it comes to rate timing.
There's absolutely, in my mind, no urgency to adjust the policy rate. Policy's in a good place right now, and I need to be fully confident that inflation is on track to come down to 2%, which is our definition of price stability, before we would consider a rate cut.
Urgency, and I see lots of reasons for patience. And over the longer term, I think my expectation is that we will ease, and that over the longer term, interest rates will be at lower levels. My baseline would still have us starting to ease later this year, but when I see is likely to be later than I had been previously thinking.
Joining us now, Christina Camp-Maney, Senior Portfolio Manager for the Global Debt Team over at Invesco. It's a pleasure to have you on this side of the Atlantic. I am thrilled to see you. Let's talk a little bit about this geopolitical conflict and the read-through here. Famously, we're talking about inflation. We're talking about these raw materials kind of driving up the inflationary story. We even have Larry Summers, for example, talking about a potential hike down the road instead of a cut, very contrarian take. But central banks don't hike in the face of geopolitical conflict. Square the two for us.
Look, I'm not the geopolitical expert here, and I think there's a lot of, as you guys said, a little bit of a sigh of relief that maybe we are avoiding the worst. But I think the point you drive on the inflation front is what makes it most challenging for the central banks, who are already in this rock and a hard place with really resilient growth in the U.S., but honestly, globally as well. We've seen the case for stronger growth, and then inflation's been stickier. So I think that they're weighing the two. I think our one confidence is that the path is still to easier policy from here. You have people that have shifted and swung the other way, but I think it's a little bit too extreme.
So that flight to safety story, or that kind of bond bull market that we were so sure was going to come 6 months ago, where did it go? How far down the road has it been pushed?
Look, we still think that there's a case that the Fed can potentially ease a few times this year. Last week, CPI brings the hurdle higher for the Fed to start. I think other central banks, you're starting to see more of a case for central bank divergence and more confidence elsewhere because you've had this U.S. exceptionalism story, and the Fed, there's more divergence even amongst the Fed, like you heard, with Collins and Daly, and Lori Logan, I think, speaks today as well, and she's been also in that camp of we can be patient, we need to wait. So I think that there's a case that you can have different roads from here.
Let's talk. You're here in London. Let's talk about European debt.
Yeah.
Let's start off with the question of central banks. How far can European central banks diverge from the Fed, do you think?
I think, again, if we zoom out 1,000 yards, right, we're still looking for easier policy. There's a lot of focus now on the divergence between U.S. rates and European rates. But when we were flat, there was no interest in that trade 6 months ago, right? So have we gone too far? I think the ECB seems clear that they want to start in June. Can there be 100 basis points of difference? Or I think the biggest question for us is the magnitude of the cycle. It seems other central banks outside of the U.S. have more room for a larger cycle, and the fundamentals might justify that more, whereas the Fed is more of an adjustment off of tightening. We don't see a case to get to or through neutral in the U.S.
So the Fed is a mid-cycle slowdown, and Europe is an end-of-cycle slowdown. Is that the correct way of thinking about it?
I think it's more that case, that growth has been slower here. And I think, when we look at the growth differential, the biggest takeaway for us is how effective fiscal policy has been in the U.S., and that's one of the drivers. And I think we were talking with one of the strategists at Bank of America, actually, about this in terms of the amount of fiscal that was put into the system in Europe versus the U.S. is actually very similar. It's just how effective has it been, or has it been tied up in bottlenecks here in terms of getting out into the market?
You know the answer to that question.
Yeah.
You talked about fiscal policy. Does the election matter in terms of rate cut timing?
It's a big debate in the market. I certainly think that the longer they wait to commence, the more challenging it is. And I think that's why you've seen a lot of people in the last week, instead of shifting their calls from June to July, which you've seen a few people, there's a lot of June to December jumps on that basis. Can they still start in July and September? I think yes. I certainly don't think they're going right before the election, but it makes it more challenging, right? You have both of the conventions over the summer. I think it will ultimately depend on the data. And it's hard because everyone in the market we're trying to predict, and it truly is data dependent day by day here with a focus on the inflation numbers. But we still have 2 inflation numbers, including the day of the Fed, but before June. And the Fed's forecast for December is 2.6 for PCE. Like, we still think that that's a reasonable case that we can get there, and you can see a Fed try and continue to stick this soft landing.
What are the risks associated with a cut that comes 5 months later than the Fed may actually want to?
I think the case for something breaking, right, we've had this conversation for the last year of can something break, what can break. The longer you stay restrictive, there is a greater chance that these stresses in the market, and are they systemic? Was SVB systemic in retrospect? No, it wasn't. But can you have things that there are more pressure? So certainly there's a lot of focus on commercial real estate, but there are kind of pockets of the market that may feel stress as we wait longer.
Is there a danger that if the Fed cuts early, the long end sees it as a policy mistake, i.e. that inflation is going to take off to an even greater degree? Short term, maybe less so, but if you look further out, policy is way too loose. It's not as restrictive as it should be even now, maybe you could argue, and therefore it's the long end that you get the biggest response in.
The debate about policy mistakes certainly feels like it's re-entered the market. But when we actually take a step back, I think it's exactly as you say, that the long end in either case needs to reprice.
How much?
I mean, one of our biggest convictions still is in a steeper curve. I think the shift that we've seen from December, when we were talking about 150 basis points of easing, to this much smaller gradual adjustment, should the curve be 100 steep or 150? I think that still is a reasonable case in the medium term. In December, people were talking about, can we see a more historical 200-300 steepening that we've had historically? I think that's harder to see when you're talking about a Fed that cuts 50 or 75 and then waits to see what the political implications of the election are and geopolitics and all these other things.
From a policy standpoint, does the ECB or the BOE front-running the Fed make that much of a difference?
I don't think so. I think ultimately all of these central banks need to respond to their own markets. I think the U.S. and the Fed has the most implications broadly to the globe. I think there's a lot of EM central banks that are acting currently, but the next step of their action kind of in the medium term will be hinged upon the Fed coming back to the table. But I think all of these policymakers are focused on what's going on in their home country and how do we address it and how do we balance this growth versus inflation dynamic.
Christina, great to see you. Great to see you in London. Thank you very much indeed for
Thanks so much for having me.
See us here. Christina Campany, Senior Portfolio Manager for the Global Debt Team at Invesco. Quick look at some of the core markets do we look at, core stocks do we look at. This is what's happening this morning. Generally a fairly reasonable bid across the board this morning in terms of these key stocks. ASML, a little bit of outperformance coming through there. The growth trade is back on. ASML, Schneider, both tracking a little higher. Nestle, a little softer as well. That's more of a defensive name. Got bid up maybe more Friday. Let's figure out what else we're watching. Joe Easton, over to you.
So we are seeing the defence stocks rising across the board this morning following the attack by Iran over the weekend. Now, the key thing here is it does feed into the play of defence spending needs to increase in Europe, and there's a lot of debate on how that will happen. These stocks all trading at very high valuations. Some of them trade on 20 times earnings, but they are still gaining once again. A little bit of a decline last week, and we're retracing a lot of that. We have got news of a price target upgrade for Leonardo this morning over at Citi, a massive jump around 70%. That stock already rallying over the past year. They see further upside for that one. Then we'll look at the mining stocks. Some of these are gaining. It is a bit of a mixed performance, though. We did have news of the spike in nickel prices and aluminium on the LME exchange in early morning trading. Norsk Hydro, as we said earlier, one of the big makers of aluminium. We've also got Rio up 1.2%, but mixed performance given they all tend to do different kinds of metals, but we're keeping an eye on them this morning. Then we've got deals. We had Prysmian. This is in the wire cables sector. That one gaining 3%. They are spending almost 4 billion euros on a US rival. That is a lot of money for them to spend, but it could increase their earnings, and therefore that one up 2%. And we finally got confirmation of BNP Paribas, the French bank, buying a stake in Aegis. This is the Belgian insurance company, the one that was previously looking at Direct Line in the UK, so it's been in the news a lot. We got confirmation of that Bloomberg exclusive that we had a few weeks ago. That one up 3% in Belgium today. The big mover, though, is Temenos, the company over in Switzerland. The Swiss technology and software firm has an independent report out on a previous short seller report, and the report says that most of the allegations were actually not founded. So that is seen as a massive relief. We've been waiting to get an update from this independent report recently, and that one is up 16% today, potentially relieving some of those concerns around the allegations from Hindenburg, the big short seller that sent that stock tumbling earlier this year. Then we'll look at those morning calls. Adidas, it's all about those Samba shoes. I've got a couple of pairs of them, and that one is double upgraded over at Morgan Stanley. That stock's up 3%. MS says it's worth 235 euros. It's trading at 202. It's the second highest price target on the street, getting a good gain today. And we've just got news of Siemens. This is upgraded over at Bank of America. So Bank of America saying that Siemens automated warehouses, so robotic warehouses, is going to benefit Siemens. According to Bank of America, they recommend you should be buying Siemens today. That stock's up 2.4% over in Germany. All about robots and Samba shoes this morning.
All right, Joe Easton from our equities team, we thank you so much for walking us through those crucial movers. Coming up on the program, another big week for U.S. bank earnings. Goldman Sachs, Bank of America, and Morgan Stanley all due to report. We're going to dive into the numbers next. Stick with us. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg.
Commercial side, we're not, those deposits have been competitive from a pricing perspective now for a while, and that'll stay the case as we look forward. On the consumer side, what we're seeing really is people spend money that's in their checking accounts, and in some cases reallocate money to CDs or savings vehicles, and that's what's causing sort of the increase in interest expense, on the consumer side. But overall, it's exactly kind of what we thought would be happening as we came into the quarter.
CFO of Wells Fargo, speaking to Bloomberg. Friday, big day for banks Friday. It continues this week as we watch for Goldman Sachs to report numbers today. We're getting into Bank of America. We've got Morgan Stanley all due to come as well. It's going to be a busy week for Jenny Serrain. She joins us now here on set. Friday, maybe not enough. Let's talk a bit about what we learned Friday. JPM, Wells Fargo. It felt like a net interest margin story. It felt like a net interest story. And it felt like an end of an era in some ways. And the market reacted accordingly. JPM was down hard.
Yeah, no, I think that's exactly right. So really coming into Friday, what we were mainly focused on was that all-important net interest income number. And certainly the banks kind of one after another all said, this is the end of the boom times with the Fed poised to cut rates anytime now this year. We're not going to be seeing the huge increases that we've seen in recent quarters. And so I think, for investors, that was a little bit of a harsh reality, and yeah, the stocks reacted accordingly. And so now they're really kind of looking to the other parts of their business. So you did hear them talk about things like capital markets finally kind of having a rebound. Maybe deal making will come back later this year, and really trying to kind of focus investors on the other sides of the business that might now starting to be coming back with rates potentially poised to fall.
Well, Torsten Slok over at Apollo said exactly that. He said there's already those early indications of things kind of picking up. But Jenny, so much of these massive trading profits have come off bond volatility. Is the capital market activity enough to offset what they might lose in that peak NIM?
I think it's a good question. It's so funny because while trading honestly came in a little bit better than expected at places like Citi and JP Morgan, it honestly was still down pretty hard. It's been one of those weird things. We like to liken it to Goldilocks and the Three Bears, where the volatility has been too much to kind of to let deal making come back or real capital markets activity kind of rebound in a healthy way, but it's not enough to get the traders really that excited. And so you've got this weird moment of both investment banking and trading kind of being on their back foot. And one of the other points that these CEOs made on Friday was the geopolitical risk is something that they think a lot of folks are really underestimating in terms of how that could affect things going forward.
So what am I looking forward to today?
Well, Goldman is a Wall Street bank, so I think, you're looking for trading, you're looking for investment banking. While those were better than expected on Friday, they're still down quite a bit, and I think, especially after the events of this weekend with Israel, hearing them really talk through kind of how they're thinking about that geopolitical risk and how that could change things going forward. Everybody's been kind of banking on rates coming down and that being like the key to better deal making. But I think, if you've got potential geopolitical risk weighing on that, how do those two things counteract?
The Wall Street bank. I love it. Bloomberg's Jenny Serrain bringing us the crucial information we got to know about those banks. We thank you so much. I want to switch focus to European earnings now. First quarter results will be pivotal for the European market after 2 quarters of misses and negative revisions. So what do we watch out for? Bloomberg's Tim Craighead joining us this morning from Bloomberg Intelligence. Tim, equity markets, they're not far off those record highs. Talk to us about what we're watching here. What's the game changer?
Well, I tell you, you hit the nail on the head with your introduction. You've got near record highs. You've got valuation that's lifted on central bank pivot sentiment. At the same time, you've had a couple of quarters of essentially negative earnings coming through. So this reporting period, I think, is particularly notable. We've got a strategy note out this morning, and we've put out a new note focusing on a handful of key companies that we think are make or break during the season.
Tim, you've highlighted 10 stocks that we should be watching out for. Why these 10 stocks, and which ones are they?
Yeah, so I think the idea here is to try to bucket a handful of ideas playing through to underlying key themes. So you think in technology and innovation, you've got names like ASML and Novo Nordisk. In the world of China, which we've hit on quite a lot being important for Europe, you've got Porsche, you've got HSBC, you've got LVMH. The world of energy transition, I think, is going to show some important points with something like Vestas, as well as what the big oil companies like Shell are going to be talking about in their analyst calls. So there are a handful of these.
Well, Tim, a lot of the names that you just pointed out are also on Guy's Sensational Six, and it brings me to wonder how much of this is a large cap versus small cap story.
Well, I think the European markets broadly, have been a large cap story. All of these companies, by and large, are large cap bellwethers that I think are going to be, crucial from the standpoint of divining what's going on with these underlying trends. When we have the opportunity to look ahead, whether it's second half of this year or in 2025, with economic recovery, stabilization, earnings coming back into vogue, that's when I think you've got an opportunity to think about small caps.
Okay, so let's think about small caps. How do we think about small caps? Is that where we've talked a lot about the European catch-up trade, and we're starting to see that being enacted? To what extent, what's the beta on that small cap catch-up trade? Well, that's hard to say on a Monday morning.
Well, Guy, I think you will need domestic recovery across Europe to drive the small caps. That's where you've got exposure to local retail, local home building, local industrial. I tell you, I'll throw a monkey wrench in your question and say, if I'm thinking about the next 3 to 6 months, given what's transpiring right now with commodity prices ticking up, with the likelihood of the Bank of England acting before the Fed, interesting note out from Bloomberg Economics on that this morning, which could bring the pound under a bit of pressure. You've got the UK that actually could be a pretty interesting haven, if not, positive return market relative to the rest of Europe that, could be very interesting to take a look at.
Certainly one we're going to be watching very closely. Tim Craighead from Bloomberg Intelligence, we thank you so much. And Guy, Tim was making that point of Shell, and I asked the question, should Shell be on your Sensational Six? Why not? And here's
I have no kind of skin in the game on this one, but Shell is an interesting one as much as it trades on such a multiple discount to what we see over in the United States. A lot of those other stocks that are on that board, and it is random to a certain extent, do trade on similar multiples to the ones we see over in the United States.
Yeah.
European tech and US tech in some ways are comparable. I think the oil story isn't, and I think therefore probably it is less of a focus. If you kind of think about where LVMH trades, Ferrari trades, these are kind of super high-end multiple stories that maybe Shell isn't yet.
And the same thing that's talking about Shell also applies to the defense story. Rheinmetall was on Tim's list, which is not on your Sensational Six. I'm wondering how much of the geopolitical
so I think
situation
that's a more interesting question.
Yeah, for those multiples to
some of these defense stocks are now trading on super high multiples. Is that sustainable? There's a number of notes beginning to come out, maybe suggesting that is going to be difficult to square. But the geopolitics could ultimately determine that. We'll talk more about what's happening with that geopolitical story and what happened over this weekend. We'll do that next. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale
and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide crate index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
The Central Command General was here for several days at the end of last week, helping them set up the entire process of air defense. The U.S., the U.K., and France, and a bunch of Arab countries helped Israel stop those cruise and ballistic missiles from getting to Israel. And there is an enormous sense of teamwork at the moment and a desire for Israel not to respond quickly. There was a war cabinet meeting held last night for 3 hours. It was inconclusive, but the impression one has is that they are not going to jump. They're going to sort of take their time and bide their time and figure out what to do next.
Ethan, how does this change the conflict in Gaza?
Well, that's a great question. I think that one of the reasons that Israel is not going to jump and respond to Iran is that it wants to finish off Hamas, as it puts it, in Gaza, and it doesn't want to be diverted. Now, the question is, because the U.S. has been saying to Israel, do not go into Rafah, do not finish the job in Gaza, let's call it a day now. I think that Israel is likely to say, look, we won't go into Tehran, but we need you to accept that we have to finish off what we started in Gaza, and we'll see where that goes. I think for the moment, Israel doesn't want to anger the United States, but it does believe strongly, and I say it, I mean this government, that it needs to do what it wants to do in Gaza. So I think that is ahead of us in the coming weeks.
Bloomberg's Israel Bureau Chief Ethan Bronner joining us this morning. We thank you as always. Of course, as he was speaking, we got a headline coming out from Iran saying that they do not want to raise tensions in the Middle East. We'll bring you more feedback as we get that from him. In the meantime, the U.S. and its allies hoping to avoid that further escalation in the Middle East following the Iranian attack on Israel on Saturday.
The president's been very clear. We don't seek a war with Iran. We're not looking for escalation here. We will continue to help Israel defend itself.
Joining us now is Bloomberg's Vonnie Quinn. She, of course, is based out in Dubai. Vonnie, talk to us about the international response here.
Yeah, I think it's obvious there's been so much condemnation worldwide, really, Critty, with a very small number of exceptions, and also, you know, appeals for ratcheting this down. And we are seeing this pretty universally. For example, Rishi Sunak, one of the first to come out and say that this was a really terrible action on the part of Iran. But we've also had the leaders of France and Germany, Olaf Scholz, and China, for example, saying the same thing. And then the supranational, multinational organizations such as the European Union, for example, NATO has condemned this, and we also have the G7. It was a phone call with Joe Biden, who had convened the G7 leaders, that resulted basically in the G7 condemning this and also saying that it's going to consider sanctions on Iran's drone and missile programs. The European Union condemned the attack and also has a meeting of ministers set for Tuesday. And then the United Nations, that's an interesting one because we already had a Security Council meeting that was called for by Israel on Sunday night. But of course, the United Nations Security Council also includes Russia and China. Those responses were a little more nuanced. Russia's foreign ministry expressing utmost concern about escalation, but also blaming the position of Western countries for allowing this to happen, right? For not allowing there to be a UN path through this. China, again, saying that, you know, the escalation was a Gaza spillover, basically, so tying the attack to what Israel is doing in Gaza. So it's been very interesting. Here in the region in the Middle East, we've had a lot of Arab pushback, which also is very interesting. Saudi Arabia, for example, one of the first Arab countries to come out and express a very dim view over the attacks. And we know that the foreign ministers of Saudi Arabia and Iran had a conversation, pretty terse conversation from our reporting, but basically they are in touch, and Saudi Arabia, among others, obviously not all, the likes of Yemen would have participated in the attack, but many of them do not want to see escalation in this region.
Vonnie, it looks like Annalena Baerbock, the German foreign minister, David Cameron, the UK foreign minister, will be travelling to Israel. There's some reporting now suggesting those trips are going to happen. What should we expect from that?
Exactly.
From that? And what concrete measures can we expect in terms of the global response?
Well, the optics alone are great for Israel, right, Guy? Because this is the first of the high-profile visits that have taken place since the World Central Kitchen workers were killed, which was not great optically for Israel and had alienated, you know, much of the international community, at least for a time. Now Israel is feeling that warm embrace again, as Ethan just said a few moments ago. So you have that on the one hand. You also have the G7 considering more sanctions on Iran. That's going to look good. That's depending on what sanctions come out. It's additional sanctions on Iran, but also asking its partners to sanction Iran. So that's more sort of hitting Iran in the pocketbook, if you like. But then other concrete measures could come from the United States. So we know that the Senate Majority Leader and Minority Leaders, Chuck Schumer, Mitch McConnell, they have already called on the House to take up the bill, which has already been passed in the Senate, which would extend funding to Israel and Ukraine. Now, there might be a problem. Obviously, there's a right flank in the House that doesn't want to fund Ukraine, and there is a Democratic flank that doesn't want to fund Israel without some conditions attached, specifically regarding humanitarian aid. So it will be difficult, but the decks are cleared. The GOP has cleared the decks legislatively to see all of these bills come up in front of the House this week, and it's likely that we will see something in the form of extended funding to at least Israel by the end of the week.
Bloomberg's Vonnie Quinn in Dubai walking us through not only the regional but the international response as well. We thank you so much. Later, of course, John Kirby, communications advisor for the White House National Security Council, will be joining Bloomberg Surveillance to discuss the latest from the Middle East. In the meantime, let's talk a little bit about the market response or the lack thereof. Oil traders largely shrugging off the attack on Israel. Prices easing on speculation that maybe the conflict will remain contained. But the question is, for how long? Let's bring in Bloomberg Senior Executive Editor for Energy and Commodities, Will Kennedy, joins us right here on set. Will, what then does spook the oil markets?
I think that the oil market has remained unruffled for all the reasons we've heard from Ethan and Vonnie just now. That none of the missiles got through, that there's a lot of pressure on Israel not to respond to Iran, that Iran has said that the matter's close to them right now. So the worst case scenarios that people would have bought into going into the weekend haven't come to pass, and that's why I haven't seen an immediate response. But I also think it would be unwise to say that the oil market doesn't care. Clearly, this does represent an escalation, and that major risks remain in the Middle East, and that the market will remain alive to those.
What mechanism is the market using to price in geopolitical tension? Now, to a certain extent, it is oil.
Yeah.
But it looks like actually it's a broader spread this time. Gold, for instance, looks like it's very much part of the picture.
Gold is very much part of the picture. We've seen a lot of movement into gold. The gold market is really surprised, and we're setting record prices regularly. I think that represents geopolitical risk, and I think it represents skepticism about whether the Fed and other central banks have got inflation under control. I think people are in the oil market. You can look at other parts of the oil market. It'll be interesting to see what call options people are buying out of the money to protect themselves against extreme scenarios, even while the flat price doesn't show that up, for example.
So we talked a little bit about the oil story and the reaction then to this conflict. Let's talk about another conflict that's having a read across into the commodity space, and that, of course, is the metal story. These sanctions against Russia now hitting the actual supply for aluminum, for nickel as well. Walk us through the price action there. What do we expect in the coming weeks?
Well, they've hit the supply of metal into the London Metal Exchange, into Western markets. I think what the market is telling us is that they expect the supply from Russia to continue. That's most importantly aluminium and nickel, but it will go directly to China. And we've already seen that happening a lot already, as we have in oil, the strengthening of the relationship between Russia and China. So what you get in the metals market is probably some sort of bifurcation, where we see slightly higher prices traded in London, where they cannot accept new Russian metal, but China will pay a discount to Russia. So the idea of the sanctions being it will impact Russian revenue from metals exports.
But ultimately, the same amount of metal ends up on the market. It just what was coming out of Russia into Europe, into the United States, just ends up in China, and some of the metal that was probably ending up in China ends up here. So net, actually, the global market is not going to be short.
I think that's right, but you are going to see some price dislocations, because obviously benchmark prices are set on the London Metal Exchange, and the new rules mean that no more new Russian metal can flow into that exchange, be delivered through that exchange's warehouse network. So that will cause some turbulence, but I think there's been no, as far as we can see at this stage, no impact on the overall supply-demand balance, as you both say.
Great stuff, Will. Thank you very much indeed for bringing us both of those two stories, even, Will Kennedy. I just want to mention as well, just keep an eye on what's happening with dollar-yen this morning, Chris.
Yeah.
Another kind of move higher. So we're up into the 51.54 territory almost now. We're approaching that. Where's the next line? When do the Japanese authorities deem that we have gone far enough? There's talk of almost the authorities setting a trap for the market. They want the market to go too far. Maybe it's gone too far already.
Yeah.
So that then they get quite a big bang for the buck when ultimately they do decide to pull the trigger on that intervention.
But this is where the technical levels really matter, right? Because last week we were talking about 152 kind of being that line in the sand. Even now 153, to your point, we have crossed. 155 was the one after that. So, and we're getting eerily close, to your point, to that story. Does this then relate to the correlations you traditionally see? Gold, the Swissy, for example, even the dollar, hypothetically. That'll be something to watch for sure.
It's interesting that the yen is not the safe haven trade that it once was. Back to kind of Will's gold and what is happening there. Not the safe haven trade, because usually you'd think of buying the yen as being maybe a way around the geopolitical story.
But neither is U.S. bonds, for example. You're not seeing a bid into treasuries either. The flight to safety does not exist right now, it feels like, anywhere besides gold.
Besides gold, which I think is interesting. So maybe we need to sort of slightly recalibrate how the market is responding to all of this. There's a lot going on with the treasury market, which makes it maybe more difficult to navigate just as a pure play kind of risk-off kind of narrative.
There's a lot to factor in to the investor case, and I'll give you one more story to factor in as well, this time on German Chancellor Olaf Scholz arriving in China on a visit marked by trade tensions. We'll get more on his upcoming meeting with Chinese President Xi Jinping next. Stick with us. This is Bloomberg.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Ratio.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, And who do you need to work with? Upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do three things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
As we get more information, we will bring it right to you on Bloomberg TV. In the meantime, let's get to our other top story here. German Chancellor Olaf Scholz has called on Chinese officials to promote free trade and equal business opportunities. He is in China to deliver a delicate message that if Beijing doesn't heed European warnings to end discriminatory business practices, Brussels will have no choice but to escalate trade defense mechanisms. Joining us now is Bloomberg's Oliver Crook in Berlin and our China government reporter Colin Murphy joining us from Beijing. Ollie, let's start with what we're hoping to achieve on this trip at a time when you do start to see a lot of these tensions really ratcheting up. And it feels like because Germany is kind of stuck in a rock and a hard place, you're not just seeing this with Germany, you're seeing this with the Netherlands, you're seeing this with the UK, you're seeing this broadly with the European Union as well. Can you walk us through kind of the ramifications in terms of the dependence that Germany has on China and why the approach may be similar or even different to the United States?
Yeah, absolutely, Kriti. And really, Germany finds itself in a very unique position in many ways within Europe in terms of its relationship with China. I mean, just to set the trip up, its second visit for Olaf Scholz there as Chancellor. He will meet with President Xi and Premier Li tomorrow. He was in Shanghai today. He arrived in Chongqing yesterday, or on Sunday, I should say, over the weekend. And really, this to illustrate the size of this is a city maybe not a lot of people in Germany have heard of. This is a city of more than 30 million people with a sort of jurisdiction the size of Austria, which really highlights how important this relationship is for so many of the companies. I mean, of the CEOs that are there, you have the BMW, Mercedes, Siemens, BASF, Bayer, Merck, all there because they have huge business operations there. And to illustrate how big that relationship is, I mean, they did more than €250 billion worth of trade last year. That unit for France is closer to 80 billion. It's much, much smaller. And on the issues of, say, Ukraine and Russia, we know kind of the Chinese position. Maybe won't get too far on that. And what Scholz needs to do is to, on the one hand, keep them on side, but also not sort of violate and step on the toes of many of the European policy goals and indeed the American policy goals. Remember, Janet Yellen was in China very recently complaining about this sort of overcapacity coming into the market and also talk about the green transition, which, by the way, also bears on this conversation about overcapacity. Solar panels are one good example, and I'll leave you with that. The U.S. has put up trade barriers with China on solar panels. Same with India because they're coming in so cheap. All of that extra supply has come into Europe, which is good for solar panel prices, very bad for the Chinese or for the European solar companies that are trying to compete.
Ollie, that's a really good point. And you bring up what happened with Janet Yellen. She was talking as well over the weekend. I think she was speaking to CNN, talking about the fact that nothing is off the table when it comes to dealing with this overcapacity. Colin, let's turn to that issue. Are we going to expect a different response to the Chinese when it comes to Olaf Scholz versus Janet Yellen?
Well, no, not really. And that was already on display yesterday when Scholz raised the issue of overcapacity in Chongqing. And when the German delegation raised that, the Chinese side basically dismissed it out of hand, describing it as based on fake news or false information. So obviously this doesn't augur very well. And it shows really the inability or the unwillingness on the Chinese side to really understand why overcapacity is such an issue for Germany, for Europe, but also for the US, as you mentioned. But of course, with the Chinese side, obviously, if they do recognize this issue, then shortly after that, people will be asking, okay, so what are you going to do about it? And that, of course, is a completely different matter because changing industrial policy, especially at a time when the Chinese economy is suffering, is not easy and will not be something that can be done immediately. So on the issue of overcapacity specifically, the Chinese may listen, but so far from what we've seen, there doesn't seem to have been any sort of fundamental understanding or shift in understanding of why this is seen as a threat by the European side and Germany as well.
Colin, don't go anywhere. I want to bring Ollie back into the picture here. Ollie, we're talking a lot about this kind of de-risking story between Germany and China. And I'm curious, is this one, plausible, and two, actually happening?
Yeah, well, it's a great question, Creedy, and depending on what you look like, you get kind of different answers to that. So again, just to illustrate how important China is to these German companies, I mean, a third of all of BMW cars are sold there, a third of Mercedes cars, Volkswagen, it's very similar. BASF, 13% of sales are there, but it's 50% of the chemical market. So for a company like BASF, they're not really considering stepping out. They're actually dumping even more money into China, but there are a couple of concerns for these German companies. One of them is competitive competition on the ground, and we had a survey out from the German Chambers of Commerce in China, and they asked them, several hundred, if not thousands of companies, basically, how do they feel in the market? And 2/3 of them have said that basically they face unfair competition practices locally within China, right? Then there's the question of de-risking from the supply chain, which is something that the government has been talking a lot about. Companies have been a little bit more ambivalent about. More than a third of manufacturing companies in Germany say that they are still dependent on their supply chain from China, though that is 10% less than it was before the war with Russia. So that is significant. But I will leave you with one thing, and that is foreign direct investment from German firms into China. That hit a record last year of 12 billion euros. So on the one hand, they want to obviously insulate their supply chains, but on the other, they need access to that market. And as you can see, the companies are continuing to dump money in.
Okay, that's the German side. Colin, what are the Chinese want out of this? It takes two sides to make a deal. What are the Chinese looking for? What are they hoping that they will obtain from Scholz's trip to Germany, to China?
Right. I think basically they want to make sure that they can have a better relationship with Europe, given the fact that the U.S.-China relations, although temporarily sort of back on track, we don't know what the long-term trajectory of that is. So, for example, should there be a Trump presidency down the line, how will that impact China? At that time, China will need to have markets, access to markets, including in Europe. But will they be able to come to an agreement on this trip? Highly unlikely, because, as I mentioned, the overcapacity issue is such a deeply ingrained issue. And also, these calls by the German side and the European side for level playing field, I mean, they've been calling for that for years with no obvious developments there. So, and then, of course, we haven't mentioned the geopolitical issues, which is, of course, Russia, Ukraine, and the war in the Ukraine. Still, again, a failure, I would say, on the Chinese side to really understand why this is such an important issue for the Germans, for the Europeans. And, the Russian-China relationship seems to be getting even more profound as each day passes, with Xi Jinping and Vladimir Putin together becoming increasingly close. And it's all part of a broader mission or positioning of China, Russia, and together with the Global South as an alternative to the US-led world view. And because of that, that's why I think that they will want to maybe try to smooth things out as much as possible, especially ahead of Xi Jinping's visit to France in early May. But in terms of any fundamental sort of agreements, I think the two sides, the differences are quite broad and quite large at this point.
Bloomberg's Oliver Crook in Berlin and Colin Murphy in Beijing. Thank you, as always, for shedding light on that crucial story. And, of course, this is going to be one of the things that we watch throughout the week. On Monday, well, today, really, we talked not only about Olaf Scholz in China, but, of course, those earnings coming out from the States, Goldman Sachs, among some of the other banks that will be reporting throughout the week. On Tuesday, that continues with Bank of America, Morgan Stanley, and right here, LVMH sales as well. Wednesday, though, is the one for me that I'm really excited about. Those ASML earnings are going to be a game changer. Yep. Kind of marries the corporate with the geopolitics. The ECB and the BOE also speaking at events when it comes to some of the policy speak that we get there. Thursday, right back to the geopolitics. EU leaders having a special summit and a little bit of Netflix earnings. There's a currency story in there. We're going to dive into that closer to then. And, of course, IMF, World Bank, spring meetings, and India's parliamentary elections begin. For me, I told you what I'm most excited about. It's that ASML story. What is it for you?
So I think Wednesday morning is going to be really interesting. So ASML will be a story, but you'll have LVMH sales and revenue after
the bell,
kind of the bell on Tuesday. So we're going to factor everything in on Wednesday. But what is interesting is the market, it feels like it's going to move quickly beyond the geopolitical tension story and back to that earnings narrative. The Goldman Sachs numbers, I think, will probably kind of sort of promote that. But we are going to have some great coverage coming up. John Kirby's going to be joining the surveillance team. We're going to continue to watch exactly what the response is going to look like over the next few hours. It looks like we're going to be seeing various trips from various leaders to Israel as well. We'll continue to track exactly what is happening there. But kind of how this all fits together with the earnings story and the macro story, I think is going to be really interesting over the next few hours. Some great coverage coming up. The Pulse is next with Francine. This is Bloomberg.
Much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. U.S. officials are trying to ensure any retaliation by Israel against the unprecedented missile and drone attack from Iran avoids further escalation and a full-blown regional war. Aluminium surges by a record on the London Metal Exchange as traders respond to new U.S. and U.K. sanctions on Russian supplies. And the German Chancellor arrives in China, calling for fair competition as he looks to avoid a trade war. So good morning, everyone. Happy Monday. First thing is first, let's take a look at the European markets map. Now, if you look at some of the futures that we're seeing in the U.S., but also here are actually equity futures in Europe, they're definitely showing signs of stability. Oil prices declining a touch. Again, traders now wagering that tensions in the Middle East will probably not escalate after Iran's attack on Israel over the weekend. I'm looking at oil dropping. Again, a touch on speculation that the conflict could remain contained, but we still talk about inflation. We look at some of the forward guidance that we'll get from Fed speakers. This is what the picture is looking like for U.S. futures. Again, investors already rattled really by sticky inflation and the prospect for higher for longer interest rates. And the last thing they probably needed was this escalation in the Middle East that injected a little bit of volatility into the markets. Now, for now, attention will definitely turn into Wall Street's earnings season, kicking off with some big disappointing numbers from some of the big banks on Friday. Today, we get Goldman Sachs, Schwab, M&T Bank as well. So you can see for the moment, S&P futures gaining some 0.5%. And I was looking at Brent crude. Let's also talk about gold. 2,351 last week was when we saw a record high. Now, to our top story, world leaders urging restraint after Iran fired more than 300 drones and missiles at Israel on Saturday evening. Now, the attacks, which were intercepted, marked the first time that Iran has targeted Israel directly from its own soil. Well, the Prime Minister, Benjamin Netanyahu, says Israel will defend itself.
I have set a clear principle. Whoever strikes us, we will strike him. We will defend ourselves against every threat, and we will do this calmly and with determination.
From our point of view, this operation is over, and there's no intention to continue the operation. But if the Zionist regime takes any action against the Islamic Republic, whether on our soil or in places belonging to us in Syria or elsewhere, our next operation will be much larger.
Now, for more on all of this, we're joined by Sylvia Westall, Bloomberg's managing editor for economy and government news in Russia, Africa, and the Middle East. First of all, there was some terrific reporting on the ground, Sylvia, throughout the weekend. I know with a blog with a lot of reporters saying up. Israel defenses held up against the Saturday night assault from Iran. How are we expecting Israel to respond to this now?
Well, the main thing that Israel has been focusing on has been how successful it was in defending from this attack. And that's important given that 6 months ago, Israel was attacked by Hamas, and there were questions raised about whether Israel could defend itself. So the fact that it defended itself from this large barrage of missiles and drones and this direct attack is important for Israeli officials to emphasize for a domestic audience at home. In terms of reaction, we've heard what Iran said. It would respond to any retaliation. It could be that things go back into this idea of a shadow war in which there are indirect attacks by Iranian proxies, and also Israel indirectly attacks Iran by aiming at proxy groups within the region. These attacks they came from Iranian soil, but they also came from other places around the region. So Israel could feasibly attack those places instead. If you look at the rhetoric of Israeli officials and what's been going on, there are voices for retaliation. There are voices saying let's have a look at things and take stock. Because the actual attack didn't cause much material damage and there were no Israeli fatalities, the pressure is easing off on Israel to immediately retaliate in an escalatory way.
So, Sylvia, what does this mean for the calls about a ceasefire in Gaza? And if there is concern about an escalation into a regional war, if not even a world war, what kind of pressure can the U.S. exercise for this not to happen?
Sure. I mean, there's the big question of what U.S. leverage is over Israel and in terms of keeping things calmer in the region. If you look at whether, the U.S. has had much influence on what Israel's been doing in Gaza, countries around the region would say that the U.S. has lost its leverage given the extent of the devastation in Gaza. The U.S. would argue that it has had an influence. So it's a big question about whether, the U.S. can actually prevent things from spreading. The next steps are on Gaza. In some ways, it took the focus away from Gaza for Israel. Israel can now perhaps go back and say that the events of the past, few days have shown that it needs to refocus its efforts on the military operation there. So all eyes will be on what the military's next steps are in Gaza and where things go from there.
Sylvia, thank you so much. Sylvia Westall there, of course, who oversees all of our coverage in the Middle East, and we were just hearing from Iran that they believe any new sanctions on themselves will not be constructive. Now, to talk more about the market impact, to also talk about metals and commodities, let's bring in UBS Chief Strategist Banu Baweja and our Bloomberg Senior Executive Editor of Energy and Commodities, Will Kennedy. Will, we'll get to you in a second because partly it's, of course, geopolitics, partly is also these sanctions on Russia. But Banu, are you surprised that markets are already stabilizing?
Look, if you wanted to, you could take away several elements of hope from what is a very unfortunate situation. The fact that Iran is saying that this is a limited, and they have concluded this phase of the operation. The fact that, thankfully, there has been absolutely no loss of life and really not much loss of property. And the fact that the U.S., while it says that their security of Israel is ironclad, they're not participating in an offensive. So, it is rational that the markets are not panicking. But we have to really agree that this is an unprecedented situation, right? This attack is an unprecedented situation. I think it completely changes the tails in the market, really. And it's coming on the back of a 20% rally in oil prices already this year. Pump prices in the U.S. have gone from 305 to about 355 already, to about 350 already. And so that, I think it is already going to begin to tell on consumer sentiment. And if oil prices stay higher for longer relative to the counterfactual, I think that will have an impact on the economy, especially at a time when the markets are already fully pricing in a cyclical recovery. So I think it really does mean that volatility changes, skew changes. And while this could be near-term inflationary, I think this is medium-term pretty disinflationary.
See, I was going to ask you, actually, there's almost an assumption that it's automatically inflationary because it means that there's more, I guess, onshoring or end of multilateralism. So talk me through why you think it's the beginning of deflationary.
Well, because if oil prices are higher relative to the counterfactual, remember what happened in 2022 when everybody was worried about the Russian war, was that in the latter half of the year, energy prices came off significantly. And that was one of the main reasons why we saw Goldilocks in 23 and early parts of 24. So if you're beginning to see a little bit of an oil, the early parts of an oil shock, I mean, it's still early to call it that. The curve is backwardated now only about $7. So if energy supplies are quite tight in any case and uncertainty is increasing, that brings increasing risks for the global economy at a time when the markets are nowhere close to price for it. At a time when the markets are priced for perfection, they are priced for Goldilocks. This does add caution into the markets and really says that at 450, the 10-year U.S. Treasury is quite attractive relative to some of the equity markets, which are trading at 20 to 21 times forward earnings. So I think from that perspective, this makes that more compelling, the bond versus the equity story.
Yeah, and I want to go back to actually treasuries in a second. But Will, what's your take when you look at, again, I think we heard from the IEA last week that actually demand is going to slow down in general for oil, but then you have these flare-ups really in a region that's very oil-rich.
I think the oil market is best characterized like this, as Banu said, that we have had a significant run-up this year, and that's because we have surprisingly strong to many supply-demand fundamentals. So far, demand has been stronger than people expected at the beginning of the year, and OPEC is keeping a very tight lid on supply. And on top of that, you've clearly got a layer of geopolitical risk. So there are good reasons for the rally. I agree that traders this morning see that worst-case scenarios were avoided, so they're not taking a new position. And the other thing is, OPEC retains a lot of spare capacity, which in worst-case scenarios, in major disruptions, gives them a policy maneuver to respond and put new oil into the market, and that's why we haven't seen a stronger reaction this morning.
Is that all Saudi spare capacity?
Mostly Saudi, about 3 million barrels a day from Saudi Arabia, but also significantly from the UAE as well.
A lot of the commodities have really shot up. How much is this because of these new sanctions from the UK and the US?
Yeah, so what we have seen in metals is the price of metals go up considerably this morning on the London and Metals Exchange, because the new sanctions mean that London Metals Exchange, which sets the global benchmark prices for many of the industrial metals we use, is unable to accept new Russian metal into its system. Now, that metal isn't going to go away. What's likely is it will go to China, and China will pay a significant discount. So you're likely to emerge a bifurcated metals market where prices in London are a little bit higher, but China, which is after all the biggest consumer of industrial metals, will benefit from paying less for Russian metals.
But going back to treasuries, I mean, I'm not surprised, but actually it's refreshing to hear that you still like treasuries, given there was an auction that didn't go so well. I mean, it was fine, but it didn't go great. And also the huge repricing that we're seeing in monetary policy, especially from the Fed.
Yes, and the market has repriced quite a lot. And to be fair, the data has been strong. I mean, we saw the CPI data as well. We do think that the disinflation, and we are with the Fed in that, we do think that the disinflationary pressure will continue, and that over time we're going to move away from 0.3, 0.4 prints on core inflation and move back towards 0.2 prints. And when I say in time, I don't mean in 5 years. I mean in the next 2 months, we should be getting there. Now, given that, what the market's pricing for the Fed, which is about 2.5 cuts this year, less than what the Fed, which is quite optimistic on the economy, themselves imply, the Fed that expects the unemployment rate to go to 4.1, themselves say we'll be cutting about 3 times this year. The market's leaving no room for risk premium. So at 491, although this has been said before, I'll admit that, but at 491, there is, I think, good value in the 2-year. And at this minute, although I think the medium-term direction should be for the curve to steepen, i.e. 2s do better than the 10s, but in a situation like this, when there's heightened geopolitical risk, the market will first go for 10s, more so in Europe, by the way, because Europe's at the beginning of a cyclical recovery, and that might be getting nipped in the bud if energy prices, mind you, nat gas prices haven't done that much, but energy prices in general have come up, and that could actually compromise the cyclical recovery just when people are moving away from the U.S. into Europe, betting on that cyclical recovery.
And we wanted to speak to you actually with Will, because when you look at some of these commodity prices, and especially the metals, really on a tear. I mean, even gold was like at a record high. What does that give to your, like strategic overview? Are there alarm bells, or are there like pockets where you see danger zones?
I think gold is a special situation. I mean, it has been a phenomenal performer, and I think it's going to perform more. The fact that gold is here, despite real interest rates going higher, is really a big statement, right? Because usually when real interest rates rise, gold prices come down. Real interest rates are the biggest driver of gold. Now you have the potential of real interest rates coming down over the next 2 to 3 years, and you have geopolitical uncertainty. I think even at 2,400, gold does therefore offer value. I mean, it has gone through our end-year targets, but we are still long gold, and we do really like it. The other metals is a different case, right? So China has been putting a lot of credit into the system, not the property part of the system, but the industrial part of the system. At this minute, we would not be chasing some of the bulk metals, certainly, right? Maybe a little bit of upside in the near term for copper, but not so much for iron ore and so on. So those metals, we would actually be going the other way. So a clear view of precious over base, over bulk.
Okay, Bannon, thank you so much. Will, thank you so much as well. That was our Senior Executive Editor of Energy and Commodities, Will Kennedy, UBS Chief Strategist, Bannon Baweja, stays with us. In the meantime, we're getting some breaking news out of Singapore. There's change in the leadership. The Prime Minister, Lee Hsien Loong, will relinquish his office on May 15th. So he'll basically step down as Prime Minister. He will formally advise the President to appoint a Deputy Prime Minister and a Minister for Finance, Lawrence Wong, to succeed him. So this was pretty much expected. I'm not sure we knew exactly the timeline, but we did have a story back in December saying that effectively Lawrence Wong was a Prime Minister in waiting. We'll see what that means for policies going forward, especially in these turbulent geopolitical times. Now, coming up, the German Chancellor Olaf Scholz arrives in China, but can he deliver his delicate message about ending discriminatory business practices? That's next, and this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're
in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
So German Chancellor Olaf Scholz has called on Chinese officials to promote free trade and equal business opportunities. He's in China to deliver a delicate message that if Beijing does not heed European warnings to end discriminatory business practices, Brussels will have no choice but to escalate trade defense mechanisms. Now let's get back to UBS Chief Strategist Banu Baweja. Banu, well, thank you so much for sticking around. First of all, so we'll talk about this relationship, which is frankly uneasy, with between the EU and China, less so than the US and China and the place in the EU. But what kind of economy are you seeing for China going forward?
So we do think that the property market stays under pressure right now, not under the kind of pressure that we saw last year, where property sales were declining by 30 to 40% annualized. I think that's likely to begin to stabilize. But what China has been doing while the property market has been under pressure is that it has been allocating a lot of credit to infrastructure, to the industrial sector. And as a result of that, if you look at China's export volumes, they've been going through the roof at a time when global trade really isn't doing that much. Really, because China's gaining market share at the expense of many of its competitors. China's gaining market share, and hence Scholz's comments about overcapacity. So when China's taking away from Peter, which is the property market, to give to Paul, which is infrastructure, and that actually means that it can compromise the global industrial complex. Right, so it really is. I think dumping would be too strong a word, but China's gaining market share very, very quickly, and that again sends a disinflationary impulse. Right now, when you look at the way European capped goods trade, you wouldn't know it. Right now, if you look at the way the U.S. curve trades or the European curve trades, you would know it. But in some of the emerging markets, this is beginning to become apparent. Like in Korea, you're beginning to see pressure on Mexico. You're beginning to see pressure on Brazil. So these emerging markets are beginning to feel pressure from Chinese exports gaining share. And I think that will continue. So China will continue to allocate. The delta over the next 6 months, Francine, is probably going to be that the Chinese consumer that has been very weak so far begins to stabilize, and that will tell in the Chinese equity market. So we're long Chinese equities as a tactical trade, have been for some time, and will remain, I think, for the next 3 to 6 months.
Banu, is there any way that Europe and the US can also counter some of the deflationary pressures coming from China, apart from tariffs?
Well, at this minute, remember, Europe and US are worried about inflationary pressures of their own domestic economy.
Yes.
But other than tariffs, I don't think Europe is going to play a currency game, right? I mean, it's not a managed currency anyway. The US is not a managed currency anyway. So I'm afraid that if push comes to shove, if they continue to feel that China is gaining market share, and unfairly so, with export prices coming down, then I think we are headed towards more protectionist policies.
I mean, the Fed, we went through the year thinking that there's almost like, global consensus on what central banks will do in terms of cuts. I mean, the Fed seems in a very precarious situation given the last inflation numbers. Are we overthinking it?
No, look, you have to think this through, because the labor market is very tight. Inflation is still quite high. But we have to remember that if you look at where real interest rates are, the Fed themselves, their median dot says 3 lower. Maybe the median dot will change a little bit, but look at where real interest rates are. Real interest rates are at 2%. This is at a restrictive level, and in fact, the market expects them to be at 2% for the next year, the year after that, and pretty much till infinity. The market's basically saying the R star has not shifted by 25 basis points or 50 basis points. It's shifted by 150, 175 basis points. That's a high bar. That's a very high bar. So it's difficult for me. The Fed will sound very cautious. The market's already taken it down to close to 2.5 cuts. Maybe it can go a little bit more, but it's not just what happens in the next 6 months. It's also what happens 1 year, so DEC 25. And that's where the Fed may have to overcompensate in the opposite direction, which is why at close to 5% on the 2-year, I think that's reasonable value.
Banu, thank you so much. Banu Baweja, UBS Chief Strategist, stays with us. We'll talk a little bit more, maybe about the UK next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Still with us, UBS Chief Strategist Banu Baweja. Banu, we were having a good spirited conversation about inflation forces and what the Fed does next. I mean, the U.S. economy seems to be, I mean, apart from last year where we thought there was a no landing or recession and then actually it kind of like flatlined through the year, is again a bit of a mystery. Like, why are markets getting it so wrong?
The U.S. economy has done very strong for a very long period of time. For the longest time, people thought this was about excess savings. Yeah. This was about the fiscal impulse. But more recently, what's also becoming quite apparent is that there is a positive labor supply shock, right? Yeah. The immigration numbers that are coming through, these numbers are very strong numbers, 3.3 million a year by some estimates. And even though the Biden administration, so not a Republican administration, the Biden administration has also tried to take these down, it has failed to do that. So that positive labor supply shock really has meant that demand for particularly goods, right? So services you would have thought would have done very well after COVID. People revenge spend on theater or on holidays. You haven't seen that much, but you actually seen goods demand become very, very strong, which is what happens when lower income people consume, sort of the low income immigrants coming in. So a lot of the puzzles in the U.S. economy, low jobless claims, very strong payroll numbers, very strong consumer goods numbers, all of these do seem to be answered by what I think I would describe as a positive labor supply shock. Right. So that seems to be happening.
So I thought productivity in the U.S. was also really strong, and you really kind of push back against that.
Well, look, the productivity data itself doesn't suggest that it's very strong, and I would completely admit, and Greenspan taught us this in the 1990s, that productivity data is ridiculous in how volatile it is, and it does get revised a lot. But when I look at CapEx, including CapEx in tech, right? By the way, much smarter people than I think that AI is as big as the steam engine, if not bigger, right, in terms of the productivity shift. But from my little vantage point, when I look at what's happening with CapEx for tech companies, for information technology equipment, for software, for research and development, the pace at which this CapEx is growing is much lower than the 1990s. So I don't really see these companies themselves being as enthused as the narrative seems to be about a major shift in productivity. So we'll find out how things go, but what I think right now is happening with the U.S. economy is not a productivity miracle, but more just a simple old-school labor supply shift. And that's why what I'm going to be watching very closely is what happens to immigration under this regime, potentially under the next regime.
We haven't even talked about the U.S. election. You have to come back, Banu. That was really fun. Banu Baweja, UBS Chief Strategist. Coming up, we'll also be speaking to Robin Niblett. He's former director of Chatham House. We'll get his view on the latest out of the Middle East. That interview is next, and this is Bloomberg.
Top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Well, U.S. officials are trying to ensure any retaliation by Israel against the unprecedented missile and drone attack from Iran avoids further escalation and a full-blown regional war. Aluminium surges by a record on the London Metal Exchange as traders respond to new U.S. and U.K. sanctions on Russian supplies, and the German chancellor arrives in China calling for fair competition, and he looks to avoid a trade war. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the U.S. is hoping to avoid further escalation, leading to a wider war in the Middle East following Iran's attack on Israel on Saturday. Now, U.S. National Security spokesman John Kirby told NBC that while the U.S. is not seeking a war with Iran, it will continue to support Israel's defense.
Whether and how the Israelis will respond, that's going to be up to them. We understand that and respect that. But the president's been very clear. We don't seek a war with Iran. We're not looking for escalation here. We will continue to help Israel defend itself.
Well, John Kirby, communications advisor for the White House National Security Council, will join Surveillance later today to discuss the latest on the Middle East. Now, for more analysis, we're also joined by Robin Niblett. He is former director of Chatham House. He's also the author of The New Cold War, How the Contest Between the U.S. and China Will Shape Our Century. Robin, as always, thank you so much for joining us. It was quite an eventful weekend, and I think a lot of people were really concerned this was the start of something bigger. Can you now discount retaliation from Israel?
No, you cannot discount retaliation from Israel. I think there will have to be some type of retaliation at some point. But I think the big difference is in what you heard John Kirby there say we're ready to defend Israel. But defending in Israel and supporting Israel on attack is, of course, a completely different thing. So the Israeli government right now is going to have to think very carefully about the options. You've got pressures inside the cabinet itself. Those like Benny Gantz, the leader of the opposition that's in the war cabinet, saying we need to build a regional coalition. We need to take our time, think and pick carefully. You've got Bezalel Smotrich, Bim Gvir on those sides, the national security ministers saying if we don't attack now, if we don't demonstrate that we can be tough, then at any moment we'd get an even bigger attack. So inside Israel itself, he's under huge pressure.
What can the U.S. do to actually try and keep this under control?
Well, as I said, nothing to the extent that they cannot, I think, stop Israel from conducting some type of attack. But, of course, what they can do is try to make sure that it is calibrated to a certain level that hopefully the Iranians would then see it as an escalation themselves, and you'd have a de-escalation rather than an escalation taking place. I think the other part is what else comes into the mix. Do the Israelis, for example, say, well, if we're not going to attack Iran in a really massive way, we need scope to be able to finish off the job and take out Hamas in the south, in Rafah, in Gaza. So in other words, what might Israel demand from the United States in return for being careful in its response would be something I'm sure the Americans will be thinking about very carefully.
But is this convenient, Robin, for Benjamin Netanyahu, because it also puts the spotlight away from, allies asking for a ceasefire in Gaza and the humanitarian crisis in Gaza?
It's helpful for Netanyahu in the sense that he now is the leader of Israel who did not fail on a security attack. He's now got, I suppose, some of his credibility back. You might say that Israel itself, perhaps psychologically, feels more secure, having seen itself be able to defend itself the way they did against this massive attack over the weekend. But you've still got the danger to the north. What if Hezbollah had participated much more actively? They've got 150,000 rockets. They could have really helped confuse an Israeli response and a defense. So if you're sitting there right now in Israel, you must feel less secure than before. You've had, for the first time ever since 1991, a direct attack on your territory. He's going to have to respond somehow.
But what's Iran's endgame here? So they say it's in retaliation for what happened actually in Damascus, Syria. What are they trying to achieve?
I think just like Israel is trying to demonstrate its deterrence, they are trying to show deterrence as well, saying to Israel, you don't get to take out 2 of our generals, 7 of our people, blow up our sovereign territory, as it was seen at the consulate in the attack that took place back on April the 1st. So they are trying to send a signal to Israel saying, you don't have the escalatory scope. We can try to cap it. But obviously what they're not looking for is a wider war themselves with Israel.
So where's China in all of this? Again, it's such a superpower, and they're fighting their own war with the U.S. Can China play a role in de-escalating or certainly stopping things from getting out of hand?
I just don't see how China has influence over Israel at this moment. Obviously, China can say to Iran, over which they do have some influence, the main purchaser of their oil, you need to think about de-escalating. Please do not respond beyond this in any particular way. But I think China looks weak and out of it, in particular, in this conflict. Just one sidebar. It's ironic that they've invited Iran to join the BRICS. An interesting choice now, historically, if we look back at the kind of conflict that we're seeing in the region.
Have you seen, you've been, at Chatham House for many, I think over a decade.
Yeah.
Have you ever seen, world politics so uncertain?
Seeing this many conflicts in a way interconnecting simultaneously, Ukraine, obviously the risk of escalation now in the region. We still have in the South China Sea a potential escalation of conflict between the United States and China. The United States has made itself very clear that they're going to defend Philippines and their sovereignty in the South China Sea. So, from a Chinese standpoint, I suppose the good thing that they can see is America is involved in all of those conflicts, right, whereas China is able to stand back and not be involved in them. So they are potentially, looking at this with a certain amount of insecurity and worry. They do not want conflict. They're trying to get their economy going again. But at the same time, I just don't think they have any clout.
But is the U.S. right in being so involved? Can they actually be involved and do a good job in all of these zones?
The U.S. has no choice but to be involved, because the strength of the U.S. is the basis of its alliances. America's strong because it has allies and has alliances around the world. The problem is, if all of those alliances are facing conflict simultaneously, then the United States obviously is exposed and the presidency is stretched as they are today.
Robin, if there was an escalation, is it soon? Is the next week, 2 weeks dangerous, or could it happen actually much further down the line?
Look, people weren't able to predict the scale of the attack that we saw this last weekend. I would say Israel's response cannot wait too long. So I think, we could be looking at a risk certainly within the 2 weeks to 1 month time frame.
Okay, Robin, thank you so much, as always, for joining us. Of course, with terrific thoughts and a briefing on what could happen next. Robin Niblet, former director of Chatham House. Now, coming up, we'll be joined by the chief executive of Novo Banco to discuss how the Portuguese bank is preparing for a possible IPO. More on that next, and this is Bloomberg.
much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Now, the conversations that matter, the insights you need. This is a Pulse, and I'm Francine Lacroix here in London. Portugal's Novo Banco has said it's preparing for an IPO in case its majority shareholder, Lone Star, wants the bank to go public. Well, I'm joined by Mark Burke. He's the chief executive of Novo Banco. Mark, as always, thank you so much for taking the time to come to Bloomberg. I'll ask you about the IPO in a second, but when you look at interest rates and actually, I guess, the divergence we're seeing between the ECB and the Fed, what does that mean for European banks?
I think it's almost extraordinary that it looks like the European banks will be the first to experience a reduction in interest rates, which normally we are a lagger. But it seems to us that what will happen is a graduated decrease in interest rates. We will still, in all likelihood, remain within a normal band. So interest rates normalized 2 years ago. They will probably decrease by 6-7 individual reductions, but we will still be working in a normalized rate.
I mean, so far, your bank, Novo Banco, but also other banks have benefited quite, not dramatically, but certainly profits have gone up because interest rates have gone up. So is it going to be tougher if the ECB actually starts cutting in June? Is it going to be tougher to hold on to those higher profits?
Well, I think we're an example just like everybody else. So over a period of 2 years, our profitability increased from the kind of 200-300 range up to about 600-700 range, 750 for last year. What we have focused on, though, is making sure that this is sustainable. And we do that through kind of 3 or 4 different elements. One was to reduce the sensitivity of our balance sheet, and our balance sheet is now significantly reduced. We've taken about 75% of the volatility out. So for every 100 basis points, we would lose about 6% of our net interest income. At the same time, we focus on our fee and commission streams, specifically around wealth management and around payments. And lastly, it's driving efficiency through the cost base. So with all of those, we, like others, would expect to maintain a sustainable level of profitability through time. So
what's your take on the IPO? You getting ready?
Yes.
So how do you get ready for an IPO?
Well, the last time we were here, I think we were about maybe one step in. So the first thing is you've got to build a track record. The idea is that to the market you demonstrate, you set, meet, and beat targets over a period of time. So we're 3 years in. We now have a sustainable, profitable business. We're very clear about the markets we're in, the service that we want to maintain, and we can show a path of profitability. That's the first part. So I would say from our results this year, we're operationally ready as a business. And then the next part is to make sure that the balance sheet is ready. So we have a couple of things we need to do. We need to do some issuance of MREL. That will allow us to release excess capital, and then essentially we have a balance sheet ready to go. After that, it's a question of markets. When are the markets ready? and selecting the team and going into the marketplace.
So what would attract actually an international investor to Novo Banco?
An international investor to Novo Banco, the beauty of us is we are a simple, pure play Portuguese bank. So Portugal as an economy is very attractive. I mean, over the last 3 years, you'll see that while the EU average in terms of GDP might have been 6 and then 2, and each time Portugal is outperforming by a multiple, often 2 to 3 times. So stable economy, stable economic backdrop, expectation of that to play out. And we are a very simple SME and retail bank in that context. So that is why somebody who wants to play Portugal and have a bank as a simple way of doing that would take the chance.
Mark, have you already appointed actually banks to help you prepare for an IPO, or is it a little bit too soon?
We have not made any specific appointment. Obviously, we have many new friends in the investment banking area, and we are obviously designing the balance sheet and getting ready, but we haven't made the appointment of our lead banks yet.
I think that last time you were on with us, you mentioned the dividend block and the fact that that would have to be removed.
Yes.
Before an IPO, but that's not going to be removed before 2025.
At the very latest, 2025, it would fall away. But there's definitely the possibility that we can organize with our shareholders to remove that earlier, and that would then allow, as I say, the issuance of MREL, the final touches to the balance sheet, and then we're ready to go. So at worst, N25, but any time between now and then, I think we can probably reach an agreement to remove that.
Mark, can you talk to me a little bit about the possibility of more consolidation between banks in Portugal, but also maybe cross-border between Portugal and Spain?
In the over 10, 15 years, you constantly hear, and it doesn't matter whether you're in UK, Ireland, Spain, Portugal markets, that this is a market that needs consolidation or that it's expected. And it very rarely happens, or it certainly doesn't happen in the timescale that people expect. So for us, we think Portugal is, it's in between the two extremes. So the extremes of an oligopolistic, Scandi, Ireland-type market, or a massively fragmented German market. 5 banks have 70% of the banking assets. What's important is that we compete, endure, and succeed in this current configuration. Consolidation takes place, it takes place. But I wouldn't be expecting anything in the near future.
But you wouldn't would you look at a possible merger instead of an IPO, or is definitely the IPO the next thing?
The IPO is the base case. If something happens or something comes up, then you deal with that as it comes up. But the only way you can really plan the bank is to say, we need to prepare, we get a prospectus written, we start to educate the potential shareholders, the ultimate shareholders, and then if something happens during that process, it happens.
Mark, what are you most optimistic about actually at your bank when you look at some of the loans? Is there a segment that's doing especially well?
No, I think for us, we are becoming very focused on being a very good retail bank. So the combination of building a customer experience which is better than anybody else in the marketplace, doing so efficiently is one side of the equation. The other is what we have always been. We're an SME bank. So the depth of the relationships, the ability to understand each sector, the ability to actually assist them in their plans that is our heartland, that is our DNA. So being able to do that, being strong enough to do that, and to be able to lend and assist them in growing. So as an SME bank, I think we get back to being what we always were very good at.
Mark Burke, thank you so much for joining us today.
You.
That was the Chief Executive of Portugal's Novo Banco. Now, we're also getting a bit of breaking news out of the Bloomberg terminal. The EU set to launch a China probe on medical devices procurement. Now, so that could, of course, lead to either tariffs, or actually it could lead to even the banning like we've seen in other cases. So for more context onto this is news just breaking on the Bloomberg terminal, let's go straight to Berlin and Bloomberg's Oliver Crook. So, Ollie, Good morning. What do we know about the announcement? And it's interesting that it's also coming at a time where the German Chancellor, Olaf Scholz, is in China.
Yeah, it's maybe not great timing for Olaf Scholz, and basically this is according to Bloomberg sources, and we may get the announcement from the EU in the coming days and weeks. And what it is basically unfair procurement practices, particularly within medical devices in that industry, favoring domestic suppliers. And of course, what it follows is that probe into the EVs that we've already got. We had Janet Yellen coming to China and talking about sort of overcapacity being breathed too much excessively into the market by China, and all of this coming as Olaf Scholz is there trying to walk that really fine tightrope line between trying to preserve the economic interests of Germany, which are, as we know, very, very vast with China. It has a much larger trading relationship with China than merely any other country in Europe. When you look at the numbers in terms of, it's about €250 billion of trade that they do every year. You know, France, which is also a huge economy, it's less than $100 billion. So it's an absolutely huge relationship. But it comes as they have been trying to step back a little bit. I mean, it's still down 15% from what it was the year before. And it's that sort of relationship right now, that awkward position where Olaf Scholz finds himself vis-a-vis China, this sort of frenemies case where you want politically to pull some distance away, but your industry and your companies and your economy are so fundamentally dependent.
So we've heard a lot about, you know, Germany de-risking from China. Is it really?
Yeah, well, this is the interesting question, right? Let's just illustrate some of the CEOs that are there with him right now, the BMW, Mercedes, BASF, Siemens, they're all with Olaf Scholz in China right now. I mean, a third of all of BMW's cars are sold there. Mercedes is similar. BASF, only about 13% of sales, but BASF have said 50% of the chemical market of the world is in China. There's no way that they're stepping in. They're putting more money forward. And Siemens, it's a similar story. But when you talk to the companies, and actually this speaks precisely to the probe that's being launched here, about 2/3 of German companies that were surveyed by the German Chambers of Commerce in China complain about the fact that there is unfair competition in the market, whether it's access to government officials, access to subsidies, to taxes, tax breaks, all that sort of thing. 2/3 of German companies are complaining about this. When you look at the supply chain, and this is the de-risking we've talked about, so German companies that are producing within Germany, how much of their supply chain is dependent on China? It's still more than 1/3. That's down 10% from before the war in Ukraine, but that's still substantial. And Francine, what is actually very critical here and very interesting is foreign direct investment in China. That has fallen off the cliff for most countries. Last year, German companies invested a record amount in developing their operations within China to the tune of about 12 billion euros. So on the one hand, you have a bit of de-risking, you have a bit of unease, but on the other, a lot of these German companies are saying, listen, we have no choice. There's no other game in town. We're going to continue to invest in China.
Ollie, thank you so much. Oliver Crook there in Berlin. Now, coming up, another big week for U.S. bank earnings with Goldman Sachs, Bank of America, and Morgan Stanley set to report. We take a look ahead to all of that next, and this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop
until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Now, it's another big week for U.S. bank earnings. Goldman Sachs, Bank of America, Morgan Stanley, all due to reports. Joining us now is Bloomberg's Jenny Serene. Jenny, I mean, you were kind of spot on Friday, and actually when we saw some of the big ones, they just weren't great. We had JP Morgan, Citi, Wells Fargo. What were your key takeaways?
I mean, I think it's definitely the end of the boom time. So you had all of these banks talking about, net interest income for this year coming down with the Fed poised to cut rates. Obviously, there's a lot of debate about how quickly that will happen or when exactly they'll start. But the main takeaway for these banks is, net interest income is not going to be in the boom times that it's been in. And we're going to have to start pivoting and really looking at other forms of strength on our books. And so you had them really pointing to capital markets. You had them all talking about this long-awaited rebound in deal making. You really saw them really trying to kind of focus on the parts of their business that might actually look really good as rates start to come down.
So what's the key metric that investors will watch out for today for Goldman?
I mean, Goldman is a Wall Street bank, so you've really got to look at things like trading, investment banking. And to be fair, trading did come in a lot better than expected on Friday at both JP Morgan and Citigroup. And they both, talked about a rebound in capital markets. And so I think those will all be positive signs for Goldman. What you did hear a lot from Jamie Dimon, Jane Fraser, some of these other big CEOs on Friday was they think the market is really underestimating what this geopolitical risk could spell for deal making in capital markets. So I think you'll probably see investors really putting that question to Goldman today, since so much of their business relies on the historical Wall Street business. Are they worried about things like what happened in Israel over the weekend, kind of undermining all of the work that they've done to get deal making back up and running?
Jenny, overall, I mean, how do you kind of, when you look at a lot of the banks, who will be best in class?
I mean, they all have their different strengths. So especially with Goldman, we think about the kind of core Wall Street businesses of putting together deals, getting equity capital markets back up and running, debt underwriting, trading, of course. And so I think for those businesses, of course, Goldman is always going to look pretty strong relative to peers. But then again, with JP Morgan, Citi, Bank of America tomorrow, those are businesses you really think about things like the consumer and kind of trying to gauge the health of the U.S. consumer. And it'll be interesting to kind of see what Bank of America says tomorrow. I know with JP and Citi on Friday, things actually still looked pretty okay. The credit metrics came in strong. Obviously, net interest income is not where these banks really want it to be, but things still looked pretty okay.
Jenny, thank you so much. Jenny Serene there with the very latest on Wall Street. Up next, Bloomberg Brief, Danny Berger and Manus Krani in New York. And this is Bloomberg.
ask you about politics. You've been involved advising presidential candidates, and I presume presidents as well. You ever have any interest in serving in a senior position in the federal government or running for office?
Absolutely, unequivocally, no.
The aggravation factor isn't worth it?
It's the aggravation factor, but it's more importantly is I don't believe there's any integrity in it.
So you do give money to politicians, though, because that's the system, but you...
It's part of the game. I think, to be honest, I think there's a need for a multi-party system in the U.S. to give more people a choice about where they can throw their voter support and their political support, but also to cause the country to sort of come together by having everybody have a role in deciding what is in the long-term best interest of the country. I've often believed that Black Americans as a people and as a voting bloc should adopt the same position that the original founders of the Congressional Black Caucus had in early 1970. Their philosophy was enunciated like this: Black Americans should have no permanent friends, no permanent enemies, just permanent interests.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Markets price de-escalation as the U.S. and allies work to contain broader conflict between Israel and Iran.
Base metal surge following the U.S. and U.K. decision to impose sanctions on Russian supplies.
Apple's iPhone shipments tumble as the company struggles to sustain sales in China. Good morning. Monday morning, we're really trying to understand, are we in another move to reprice risk? There's also more to come on banks.
It is. It's a busy day, Manus. Whether it's repricing oil, whether it's repricing treasuries, it's the de-escalation that we're focusing on now.
Indeed, and that is manifest in oil, in treasuries, and in equities. Don't forget, last week was a pretty brutal week. The S&P 500 was down by 1.5%. We're now going for a mini bounce. The language from the United States is, according to Axios reporting, that Biden would not support a retaliatory strike by Israel on Iran. Cameron talks about think with your heart, not your head. So you are seeing this geopolitical narrative rise. Dan Ives has a cracking note. Danny, you shared that with me. Now is the time to buy the dip. A sell-off in tech is a buying opportunity. Keep an eye on Apple at the bottom of your screen, down 0.7% as their shipments fall by 9.6%. So again, this is about the first quarter and shipments are under pressure. NASDAQ trying to grapple with a bounce there. And stocks in Europe also up. Keep an eye on Adidas. Adidas really taking a monster bid this morning. You have Morgan Stanley double upgrade there. Overweight. Take advantage of the lull in Nike and €235. Danny.
Manus, it is remarkable the amount that oil has dropped this morning. It's only 1%, but this is the important thing to keep on mind. This is cheaper than where we were last Monday. It is cheaper than where we were 7 days ago when we were at $86 a barrel. We are just below $85 a barrel right now. It is the market treating this as the risk of escalation is over. You see that in treasuries too, which were bid on Friday. That haven bid finally coming into the four. We're still above 4.5%, but we're up about 4 basis points after the rally on Friday. Aluminum, that is trading at a record. This is LME aluminum. We're at $2,552, up some 2.33% after the U.S. and U.K. imposed new sanctions on Russia, saying to them, you cannot put new metals into the LME. But trading still happens beyond the LME, but of course it impacts prices there. So it is higher this morning, along with nickel at the same time, Manus. And you've got some breaking news.
A little bit of breaking news just carrying forward. We saw that shipments from Apple down, but this is on the chip side. Samsung, they're going to get $6.4 billion in grants for chips here in the United States of America. Now, the interesting thing here is, Danny, Samsung will not be tapping the CHIPS Act loans and guarantees. You remember Intel and Taiwan Semiconductor both went down that road. No, they are going to take advantage of some tax incentives. So it's going to be a 25% of the qualified capital expenditure. So it's about an exemption from tax they're going to build out in Texas. So this is a materially different incentive, but it is an incentive nonetheless of $6.4 billion, but it's not in the CHIPS Act. So we'll see how that plays out through the morning. There is Samsung Electronics over the space of a year.
So while we keep an eye on what Samsung does when it reopens tomorrow, what the rest of the chip space does, it is all about oil. It is about escalation and the risk that there is a material escalation. Manus, as we've been talking about, this market is not trading as if there will be an escalation. This is what Halima Croft says over at RBC, that the war may move down the escalation ladder if the Israeli government follows the advice of the White House and forgoes retaliatory action. The reporting from Axios, as you mentioned, Manus, is that the White House says they would not support Israel in a retaliationary act.
And we're going to catch up with Rapid and Energy a little bit later on, Bob McNally. And Bob's first take on the first piece on the top line of his note is this relief sell-off in crude is largely on, as he calls it, a flopped Iranian attack in the absence of an immediate Israeli response. And that is what the Brits and the Americans want to try and contain. We don't know where this goes. We don't know what the response mechanism will be.
Right. What we've heard from Israel so far, though, hasn't necessarily been one of we're steadfast in not responding. Benny Gantz, for example, said Israel will exact a price from Iran in a way and time that suits us. But Israel and its allies, Manus, did intercept most of the attack drones and missiles launched in Iran over the weekend. Prime Minister Netanyahu addressed the nation yesterday.
The state of Israel is strong. The IDF is strong. The public is strong. We appreciate the U.S. standing by Israel's side, as well as the support of Great Britain, France, and many other countries. I have set a clear principle. Whoever strikes us, we will strike him. We will defend ourselves against every threat, and we will do this calmly and with determination.
Bloomberg's Golnar Motivali joins us now, who covers the Middle East and Iran for us. Golnar, we have had messages. I mentioned Benny Gantz saying that we will respond in a way and time that suits us. Itamar Ben-Gvir, the national security minister, called for a crushing attack. I mean, that's not exactly language that Israel is just going to stand by and do nothing.
Yeah, I think that's right. I think in the same way that Iran had to respond to the Israeli strike on its consulate in Damascus. And by the same token, I think definitely the calculation in Israel is that it has to respond somehow. It can't allow a precedent to be set for sort of direct attacks from Iran to Israel, you know, despite the strength of the Iron Dome and the force of Israel's allies. I don't think they obviously want this to go unheeded. They can't. I think politically, it's not something that they can just forego. But I think that reaction has to be very calibrated. We don't know what it's going to be. We know that they had a war cabinet meeting that was inconclusive, and I think right now Netanyahu is probably kind of having to balance these two very loud demands. One is from the extremists and hardliners in his own cabinet, like people like Itamar Ben-Gvir, and then on the other hand, by the Biden administration that, as you mentioned, has said that it won't support, reportedly said that it won't support a direct strike by Israel on Iran. So the reaction is going to be careful, but I think it's going to have to react somehow.
And, you know, this is where Cameron, you're based in the UK at the moment. Cameron said, I said at the start of the show, think with your heart, not with your head. But of course it is think with your head. as well as your heart. That's what he said to Sky News. Ziad, our chief emerging market economist, said Iran designed its retaliation to cause maximum symbolism, but minimum damage. And the question is whether that damage permeates from the firing of missiles into attacks via the proxies in the Strait of Hormuz. There was a boat captured over the weekend. Oil is really batting this situation away at the moment, Golnar. Why?
Well, I think a lot of this was factored in, right? So we had a lot of noise diplomatically. Obviously, Bloomberg, we reported this story quite early on, that the Americans and the Europeans were definitely expecting a reaction from Iran within hours, within days. So we were expecting that on the weekend. We were all waiting for it. And then, of course, when it came to Saturday night, we knew when the drones were in the air. Israel was in a position where it could kind of count down the minutes to when these things were supposed to enter Israeli airspace. We even have reportedly Jordan intercepting one of these missiles, at least over Jordanian airspace. And we know that Iran, from our own reporting, flagged this and telegraphed this to its allies and those countries in the Middle East, and particularly in the Persian Gulf, like Saudi Arabia, like the UAE, that it's trying to mend bridges with recently. It's actually made an effort to be very transparent about what it was going to do. And that's why. So oil really priced this in, I think, before it happened.
And it's the sentiment I've seen in one or two notes, which is the message to Israel, which is to take this win. In other words, that defense mechanism happen. We understand there'll be other conversations with Bibi later on today, Schultz and Macron. We understand talking to the Israelis. Golnar, thank you very much. Bloomberg's Golnar Matavali. Other stories trending on your terminal. This Monday morning, the German Chancellor Olaf Scholz has begun his second visit to China. He's expected to deliver the delicate message that Beijing has not acted on European warnings to end discriminatory business practices. Sources say Scholz wants to persuade the Chinese President Xi Jinping that he needs to act soon to avoid EU tariffs meant to rebalance the trade relationship.
Prime Minister Lee Hsien Loong of Singapore will step down May 15th as part of a long-planned succession, ending a 2-decade run. Deputy Prime Minister Lawrence Wong will become the city-state's 4th premier the same day.
CVC has revived plans for an IPO in Amsterdam. The buyout giant seeking to raise at least 1.25 billion euros, with investors in a listing that potentially paves the way for other private equity firms to go public. Coming up, we'll dig deeper into this oil market post-Iran's attack. Bob McNally from Rapid Energy joins us later this hour. First take.
But up next, we're going to catch up with TD's Mark McCormick on why he doesn't see much strength in the dollar until later this year. This is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Bloomberg Brief. I'm Manus Cranny with Danny Berger here in New York. So Monday morning, what have you got? Well, the dollar is taking a small breather from a rally that it saw last week on the back of geopolitical concerns and the resilient U.S. economy. TD's Mark McCormick sounding the alarm, writing the following. The market has ignored the fact that growth data outside the U.S. converged with the U.S. These conditions create limits to the dollar rally and reinforces us with the most of the best trades are on the crosses in the near term. Mark joins us now. He is the head of Global FX and EM strategy at TD Securities. Mark, I look at G10 this morning. There is a definition of haven. It is the dollar this morning. I know that cross assets are trying to grapple with a de-escalation narrative, but it's interesting to see the dollar. It's not just got a row story, but it has that haven status. It's affirmed, isn't it?
Yeah, absolutely. The thing around the dollar is that it offers high carry. It does offer the liquidity of U.S. Treasury markets, and also at the same time, it's also a relatively decent growth story. So along with the geopolitical tensions we've seen and the push towards higher oil prices, we've also seen essentially higher inflation in the U.S. So these are all factors of last week that have really kind of worked in the dollar's favor, particularly against the G10 currencies that just don't have a lot of those factors. So the way we're kind of looking at it is if you kind of look at FX more broadly, there is a divergence between emerging markets where there's certain currencies that do well with higher inflation and higher oil and higher energy, and certain G10 markets which actually just don't do well in those environments either. So we do like some of the cross stories here like Euro Brazil or Swiss versus yen, or even if we look in Asia, there's a lot of nice trades you can see like funding out of renminbi into currencies that might do well in a favorable global growth environment like Korea.
Mark, I know you also write that year-end Q4, you might see some real strength actually coming from the dollar because of things like geopolitical risk, because of the election risk. Mark, is it not time to start pricing that in now if you look at what happened over the weekend, that risk is still very alive, and of course that's going to matter even more for an election and who's sitting in the White House?
Right, so I think a lot of it has to do with like first and second order effects. So the really interesting thing about the dollar is Q4 of last year was all about the growth convergence with the US. We see it in our models that the dollar was much more responsive to growth, which is why it sold off so aggressively. First quarter of this year, that was really all about the acceleration of US inflation. So what we did is we coined this basically, everyone talks about the dollar smile. This is almost like the dollar's inflation smile. So part of it, though, is we still believe in the disinflation narrative. Service inflation is driven primarily by wages. Wages are still kind of moving in the right direction. And also, if you think about what was very important from the CPI is housing. And if you look at the rents and some of the higher frequency data, that should continue to deflate as well. So there's still scope here that the Fed can cut in the summer, which is what we're expecting, which allows the Fed to kind of move in the same direction as everyone else. So if we take our eye off the inflation narrative again and we move back towards a growth, I do think there's room to tactically kind of trade the weaker dollar through Q2 and Q3, but that's the first order effect. And then the second order is now we need to think a little bit more about the geopolitical risks, but we need to get past U.S. conventions, which are in the summer. We also need to kind of work through these macro drivers that are more important in the election, just given how far off it is.
Look, we'll come back to the divergence story because ultimately it comes down to whether you believe the Fed and the ECB are going to have a massive gulf between them. It sounds that you're saying perhaps not. I'm curious to know, I look at dollar yen, I look at geopolitical situations. We are far from done with understanding what the Iran-Israel conflict is. I look at dollar yen this morning, 153.76. That's the dollar rather than yen. That is dollar strength. But what are we not understanding about the Bank of Japan? I mean, it would typically be in periods like this that the yen is much stronger and better bid, and it just simply hasn't been.
Yeah, the Japanese yen's through, I'd say, the last couple of years has lost its properties around, a safe haven. Again, and if you think about the nature of a safe haven, the most important safe haven we have right now is gold, which is why gold is running at $2,400 per ounce. I think a big part of it is markets aren't worried as much about a recession as they're worried about inflation. And again, if you think about the geopolitical risks we have going on right now, this is inflationary. Largely, again, if there's any disruption to oil supply like we saw with Russia, Ukraine, 20% of the oil market basically runs through the Strait of Hormuz. So there's elements here that oil has been firmer because of positive demand, also the reopening of China, the moving around of the population a little bit more. You can think about jet fuel and things like that. But it's also driven by supply issues. So the yen is not primarily, I think, a great safe haven in this environment, largely, again, because most of the flows that are moving yen are Japanese institutional investors moving yen offshore. I think a big part of this here, though, is you have to kind of think about the more the yen weakens, and you're seeing this already in Asia, the Bank of Indonesia, you're seeing with the PBOC, they're trying to verbally intervene in the market, especially with their fixings. We're getting to the point where Asian central banks are very uncomfortable with weakness. So the further the dollar-yen moves closer towards 153, 154, the more likely the Ministry of Finance is going to come in. They obviously want to have the asymmetric risk to kind of spook the market and catch it off guard. So there are also limits to the dollar strength just from the Asian stories where there is divergence on interest rate differentials. But another big part of this is that the BOJ, the more the yen weakens off, the more they're going to have to respond.
Yes.
Even if, again, if you poll a lot of investors ahead of the last hike, no one was expecting this to start the year.
Yeah, I mean, Kanda, Japan's chief currency chief, has already been speaking this morning, saying that they're in frequent contact with FX officials abroad. They're arranging the first U.S.-Japan FinMin meeting with South Korea as well. Mark, we're going to have to end it there. Thank you so much for your time this morning. Mark McCormick of TD Securities. Mans, before we end the block, we got to talk about what metals are doing this morning.
Roaring.
Aluminum at a record. Surprisingly, copper is starting to come down, but aluminum up 2% off the back of new sanctions from the U.S. and UK saying Russian metals cannot be placed in the LME, at least new supply of Russian metal.
Yeah, I mean, this is what you call asphyxiation. You say aluminum, I say aluminium. And of course, in 2022, the LME themselves were considering banning Russian metal into the exchange. They decided not to. Where is the winner in this trade? Maybe it is China who gets to gorge on even more supply that will be diverted from LME into China. Gold is bid, as we just heard from Mark there, incredibly strong. And you have a nice big note out this morning from Goldman's, 2,700. Unshakable bull market in gold. We're going to talk about Apple, less shakeable or not. This is good.
Names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be
early days on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Danny Berger alongside Manish Krani in New York. Apple has had a tough start to the year. iPhone shipments have slid 10% in the first quarter. That's according to market tracker IDC. Its dominance in China continues to be challenged. On that, let's bring in Tom McKenzie, who joins us for more. And Tom, we had known that Apple was struggling in China. So how much worse are these numbers?
Yeah, you're absolutely right. There's been a drumbeat of bad news in the last few months, since the start of the year, really, about Apple's prospects, and all of it has come down, as you say, to China. You talk about the almost 10% drop, so that equates to about 50.1 million mobile phones that were shipped in that period. The expectations were that you'd be getting about 51.7 million. So you're talking about a drop of almost 2 million versus the estimates. It's the biggest drop that we've seen, in fact, since COVID-19 and all the snarled supply chains that impacted Apple then, of course. So it is significant. And again, to the China factor, the competition is real. You're seeing that from the likes of Xiaomi. You're seeing that from the likes of another company as well, another smartphone maker in China called Transient, coming out for some cut-price phones. Their market, their sales in the same period grew about 80%. Xiaomi's grew about 30%. This, as Apple, dropped about 10%. All at the same time, as well, as you get this ban coming through from China on people bringing in smartphones into companies, state-run companies, state-owned companies. So that's affecting, of course, millions of people in China as well. So the competition is there, and the restrictions you're seeing in place, and it's starting to have an impact, clearly, on the sales of these smartphones, the Apple smartphones in China.
So what about the health of the overall market? I mean, is this an Apple malaise? Because the rest of the market seems to be doing grand, and on top of that, raising prices.
Well, that's it. The top line is that this market has rebounded from the struggles that it's faced in the last couple of years. It's been one of the best years, in fact, for a number of years for the smartphone market. You saw overall growth of almost 8%. Samsung remains number one. Apple's still holding that second place. That Xiaomi is catching up, though. And again, the growth that you're seeing, the pickup from a low base, of course, for the likes of Transient and Xiaomi is something that is obviously going to concern Apple. Apple has the pricing power still. It is still commanding the highest prices in that market. But you're absolutely right to point out that the broader market is turning around. But for Apple, you're seeing that drop, and that challenge continues. They're, of course, trying to ensure that they can build out supply chains in other countries like Vietnam. They're focused on India as well. So they want to build out their footprint there. But for now, the Chinese market remains a challenge for Apple as these competitors come to the fore.
Tom McKenzie on the Apple story, the pressure on Apple. The rest of the world benefits. Tom McKenzie. Coming up, we're going to talk about oil. But before that, Danny, let's just reflect. I mean, the geopolitical pressure on Israel is mounting. And we understand Macron is talking about a calibrated manner to Bibi.
Yep, and local media is reporting that Israel's war cabinet is set to convene yet again today. And the military has presented the government with possible responses to Iran. We're going to catch up with Bob McNally.
part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but where it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Back to Bloomberg Brief. I'm Menace Crenny in New York.
And I'm Danny Berger. Here's what you need to know.
Markets price de-escalation as the U.S. and allies work to contain broader conflict between Israel and Iran.
Base metals surge following the U.S. and U.K.'s decision to impose sanctions on Russian supplies.
Apple's iPhone shipments tumble as the company struggles to sustain sales in China.
And more bank earnings are upon us. Goldman reports today, and Morgan Stanley and Bank of America tomorrow. Manis, it is remarkable that oil is trading just above $84 a barrel, despite all the calls we've had for $100 a barrel that have grown after this conflict.
It definitely is. It's a reset in price, but then it is de-escalation is the narrative. It's de-escalation across assets this morning. And will that hold? The Germans, the French, the Brits, alongside the Americans, are calling for a de-escalation.
Well, local reporting does suggest that the Israeli War Cabinet will be meeting today. In the meantime, Manis, let me show you what oil is doing exactly. We have dropped by about 1%. We're down more than that at the moment, 1.2%, let's call it. But again, we are about $2 cheaper than where we started the week last week. It is a lower crude price, despite the conflict and the potential escalation and whether or not that's priced in. We're also seeing the 10-year yield. That's also reversing some of the losses we had on Friday. We're up by about 3 bips, over 4.5%. Meanwhile, aluminum trading at a record. This is after the U.S. and U.K. imposed new sanctions on Russia, saying new metals cannot make their way to the LME. The important thing about this, man, is to some degree that is symbolic. Plenty of non-U.S. entities can still trade Russian aluminum, nickel, and copper. You just can't store it at the LME. So sure, it matters for prices on the LME, but for the global metals trade, perhaps not as much.
Well, it certainly opens the floodgates for more supply going into China. In terms of these markets, we are trying to understand what is the next evolution of risk. De-escalation seems to be the narrative across assets. Stocks were down by 1.5% throughout last week. So we have this small bounce. Wedbush Security, Dan Ives says, take your opportunity on this drop in tech. Any drop in tech is something that you want to embrace and to buy any sell-off that there is. Of course, this quarter's earnings are going to be a major positive catalyst for tech, he says, and it has the capacity to rise by another 15%. We've got to wait and see what that War Cabinet comes up with, because, of course, bonds really did behave as a haven on Friday. We give a few basis points back there this morning. Europe is up by 31%. Take a look at Adidas. I mean, what an amazing spike this morning. Morgan Stanley says take advantage of that lull, as it were, in Nike. The stock is up just under 5%. It's a double upgrade. They go to overweight and they go to 235 in terms of price. 204.60 is where we are at the moment. Danny.
Manis, a lot of what we're getting out of pricing that would be geopolitical risk, the confusion about it is it runs very counter to what has been the trend this year. That is disinflation, that is weaker dollar, and we heard that tension speaking with Mark McCormick of TD, who we had on just moments ago, saying that he was expecting a weaker dollar because of the disinflation narrative. But what happens if the price of oil goes higher? Or are you trading dollar as a haven?
And on that haven status and on the divergence trade, he feels that the dollar will drop a little bit later on in the back end of the year because we are overestimating where the inflation narrative will go to. But look, we'll talk more about that FX story. And by the way, yen is not your haven that you all thought it was, as it traditionally was. Exactly, they've got a whole other issue to deal with in terms of the Bank of Japan. But let's talk about today, because there's a whole reset here in New York. Donald Trump is set to become the first former U.S. president to face a criminal trial. This comes as the Republican nominee is fighting his battle to retake the White House. She's here. She's in New York. It is Katie Lyons. Good to see you this morning. Welcome back to the set from whence you went. Talk to us. What kind of political and legal theater will we get this week?
Well, quite a bit. This week maybe less so because it begins with jury selection today. They're going to try to find 12 jurors who can be unbiased in assessing not just the current presumptive Republican nominee, but a former president who they all likely know very well. So they will be asked things like whether they have a true social account, whether they've ever attended a Trump rally, as they try to find a dozen individuals who are going to be able to assess this case. Now, in this case, of course, what we're dealing with here is 34 felony counts that Trump has been charged with of falsifying business records. This is allegedly in attempts to conceal hush money payments paid to porn star Stormy Daniels just ahead of the 2016 election. And in doing so, according to prosecutors, he violated election law, which is what has raised this to a felony. Trump, of course, denies all of these charges. He has suggested potentially that he could be testifying himself in this case. We also will likely hear from witnesses, including potentially Stormy Daniels and Michael Cohen, his former attorney and fixer who made these payments to her in the first place. So certainly a lot of theater could be expected. These counts individually each could carry a maximum sentence of up to 4 years. So if he were to be convicted, there is the question of whether he would serve prison time. And of course, amid all of this, he's still going to be actively campaigning to once again retake the Oval Office and be president of the United States.
Right, because part of the question about him being convicted is not just what time, what punishment there potentially is, but what it means to potential Trump as president.
Exactly. Now, being convicted of a felony, surprisingly, would not actually prevent him from running for president or holding the office, but it could have implications for how likely people are to vote for him. On the one hand, this is every day he has to be in the courtroom except for Wednesdays. That's going to take him off the campaign trail. He is spending a lot of money on his legal defense, which drains campaign resources that could be spent elsewhere. But also the polling that Bloomberg has done together with Morning Consult suggests that in the 7 swing states that are very likely to decide the result of the election, more than half of voters say if Trump were to be convicted of a crime, they would not vote for him. So it could impact ultimately turnout and whether or not people are willing to cast a vote for him in November.
Well, it's certainly the world is watching in regards to what happens in Israel and Iran. And the National Security Council spokesman John Kirby spoke yesterday about the White House's response to Iran's attack.
The president's been very clear. We don't seek a war with Iran. We're not looking for escalation here. We will continue to help Israel defend itself.
So the debate is the war cabinet meets later today. Iran's attack on Israel was well telegraphed. The question is escalation, de-escalation risk. Katie, I mean, we've got global leaders now making it very, very clear. Emmanuel Macron talking about Iran's attack over the weekend, the response in a calibrated manner. We've had tweets from Foreign Minister David Cameron talking about the head and the heart and the, sort of the recalibration. And the White House is not keen to wrap its arms around a further retaliatory escalation. Just quantify that for me, qualify that for me.
Well, what we've seen from this administration is they stand by their commitment, which they describe as ironclad, to support Israel's defense. And certainly we saw U.S. military forces acting defensively, helping shoot down those 300 drones and missiles over the weekend. What the U.S. seems less willing to support at this time is offense. Axios reported over the weekend that Biden, on the phone with Netanyahu, suggested that the U.S. would not join an offensive retaliatory attack against Iran because of those very concerns around escalation. Now, as we've seen with the Biden-Netanyahu relationship in recent months, which of course has grown more tense because of the ongoing operation in Gaza and the high civilian death toll that has been exacted there, there is tension in the relationship, and the administration has been really pushing Israel to have more restraint. That isn't always necessarily heeded. Ultimately, this decision is Israel's own, and so that's what adds the complication. Of course, this attack against Israel has fortified the idea that, yes, this is an alliance that the U.S. is standing behind, but the U.S. at this time is not really eager to see things escalate further in the Middle East.
Kayleigh, a busy day for you. Thank you for joining us, for getting up early. That's Bloomberg's Kayleigh Lines. So oil is dropping this morning after Iran's attack on Israel. Prices are slowly easing. And it really represents that this market is speculating that the conflict will remain contained. Let's get over to Bob McNally, founder of Rapidan Energy. Bob, this is an oil market that is now priced more cheaply than where we were on Monday before Iran attacked Israel. Is this market overlooking the odds of escalation?
Good morning, Danny. I think it is still. At Rapidan, we actually increased our odds of a material disruption from Arabian Gulf oil and gas flows from 30 to 40%. I would say the market's closer to something like 5%. But, you know, the sell-off today is pretty predictable and understandable. The high interception rate enabled the market to dodge a bullet. So I think it's understandable that we're soft today. Israel's going to take its time and enjoy the benefits, the strategic benefits of this weekend, especially in terms of a regional alliance that stood up and protected it. So it's going to take its time. The lack of casualties really enables Israel to take its time. But I think we're in an escalatory dynamic, a slow, steady, but sure escalatory dynamic. Israel has an agenda. It's not just Gaza. It needs to address its security risks in Lebanon and with Iran. And we're heading in that direction. And so the risk trajectory, we think, is still up.
Bob, good morning to you. In terms of where that escalation risk comes, it's more likely via the proxies. Do you think the risk, and you've focused on this in the Strait of Hormuz, do you think that that materially changes in terms of a risk element? There was a tanker attacked over the weekend. So are the odds of retaliatory Iran action now likely more to focus on the Strait of Hormuz, or do you think via the proxies?
I think, Manis, it's going to be two avenues. One is Iran's top proxy, the big one, Lebanese Hezbollah. Israel's determined, after Gaza is settled, to push Hezbollah away from its northern border. Unlike Hamas, Hezbollah is Iran's top proxy. They will defend it. So that's one avenue through the proxies. And then, as you mentioned, Iran seized an Israeli ship. Iran blamed the United States for Israel's action and explicitly warned over the weekend. President Biden said, you better rein in Israel or your bases will be attacked. So I think when we think about this shifting to the Middle East, there's two problems. One, the Strait of Hormuz, but let's not overly focus on just the Strait of Hormuz. There are key energy infrastructure facilities in the region, Abqaiq, Khurais, that have been attacked. Those are also targets that Iran could, and its proxies could hit again.
Bob, a political reporter tweeted this out. They haven't written a story about it, but she tweeted it out saying that one of the House bills expected to be brought up this week aims to make the Iran Sanctions Act of 1996 permanent, was set to sunset in 2026. So there is clear language, at least coming from Congress, about potential sanctions or keeping current sanctions for longer. What would that mean to oil if sanctions are now being brought up again and potentially taking Iranian oil off of the market?
So I think Congress is very angry, especially Republicans, that the president has more or less looked the other way and allow Iran's production, your colleague Javier Blas has pointed out, to get to very high levels. And so, but you know, when it comes to national security and issues like this, the White House has a lot of power. And I think the Senate also can stop this type of thing. So I think President Biden is still going to be in control. It's up to him whether the United States tightens enforcement on Iranian sanctions. I think the House bill might pass, but it's the Senate and the White House can probably slow it down this year anyway.
Bob, you say that this is a classic reaction in the oil market and that perhaps it will last for a short period of time, but you still fundamentally believe that we have a stronger demand in China and a tightening market and the ability of OPEC Plus to release even before the June meeting should it need to. So just extrapolate for us, do you think that we steady in this bandwidth 90 to 93 without a retaliatory action, a significant retaliatory action from Israel?
Yes, Manus. Rapidan models Brent fairly priced on a quarterly average basis in the high 80s, low 90s, as we sit here in a tightening market, well controlled by OPEC Plus, I must say. However, we do think geopolitical risk will add at least another $3 to $5 per barrel in the coming weeks, and probably more than that. And the problem is the high OPEC Plus spare production capacity, the buffer, is unfortunately inside the Arabian Gulf. It will not do us much help if this conflict expands regionally to include Iran. So it's balanced with strong upside risk in our view due to underappreciated, underpriced geopolitical risk.
And as you say, the geography of the excess production is perhaps more at risk than we really have grappled with in these markets this morning. Bob, thank you as ever, giving us your first take at Rapidan Energy on the response to the oil markets. Coming up, investors away. You got it. More bank earnings. It's your favorite thing. Goldman Sachs. Did they have good volatility or bad volatility? That's the question. Stock down 1% ahead of the opening call.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Brief. I'm Manus Scranny alongside Danny Berger in New York. You got it. More bank earnings that are going to roll across the tape today. Goldman Sachs, the results first, followed by Morgan Stanley and Bank of America tomorrow. Joining us now, it is Saul Martinez, Senior Finance Analyst over at HSBC, our guest this morning. So, Saul, good morning. You had first flush with Citi and JP Morgan on Friday. We'll come back to those in a moment. It is Goldman Sachs, the very edification of Wall Street. Do you think they had good vol or toxic vol?
Hi, Dan. Thanks for having me this morning. I think it's a good vol. I think this is going to be a pretty good number. We're expecting $9 a share. That's a little bit above consensus, which I think is around $8.80. But there are a couple things here. One, the sales and trading numbers at Citi and JPM, relative to expectations, I do think bodes pretty well for them. Now, their sales and trading and markets numbers are a little bit different. They're a little bit more skewed to equity than fixed income relative to those, but equities actually outperformed, so I think that bodes well. And I think investment banking is going to, you saw a lot of strength at Citi and JP Morgan. A lot of that was in debt capital markets, and they are underweight debt capital markets versus those firms, and M&A hasn't rebounded just yet. I think, we are seeing more announced deals, and that does bode well for the second half. So I think they'll send a message that the pipelines are good in banking. You obviously had good markets, strong markets and higher asset prices. That does bode well for asset and wealth management. But I think the bigger question is about the outlook. What's the outlook for banking, especially given uncertainty on the rate backdrop, whether rates staying high for an extended period of time will impact them. Again, I think they'll highlight the strong pipelines. But we did hear from JP Morgan that they think that debt issuance was actually pulled forward a bit, and the regulatory environment for M&A remains, a bit of an uncertainty. But even then, we are constructive on Goldman.
Well, with M&A, regulatory-wise being an uncertainty, if rates are potentially staying higher for longer, do you expect David Solomon, for example, who most recently a month ago said he's optimistic about 2024 with capital markets rebounding, can they stay as optimistic, Saul, with all of these uncertainties that at least last year when we had inflation resurging, put a brakes on the M&A market?
Yeah, I think they will stay positive. I think there's still a lot of uncertainty around the timing and the magnitude of the recovery. But if you look at investment banking activity, you are at near decade-long lows. So the direction of travel likely is higher. There's still just an uncertainty about the timing and the magnitude of a recovery. I think as long as the view is that the next rate move will be lower, obviously there's uncertainty around timing. That I think is positive. But I think they'll highlight the pipelines being strong, and also the need for financial sponsors to exit assets that they've invested in, and they also have a lot of dry powder. So there are a lot of factors that still suggest as long as equity prices and asset prices remain relatively elevated, you'll see an improvement. But admittedly, relative to a month or 2 months ago, maybe that view is a little bit less clear in terms of the timing and the magnitude of recovery.
Saul, I'm looking at the price action on Friday of JP Morgan, down 6.5% for cash. Jane Fraser, she had less of a drive-by. She was down 1.7% at Citi. Now, the narrative is that net interest income is a battleground that's going to become harder for these banks. Now, we seem to have sold aggressively to JP Morgan on the underheading on the NII. Jane Fraser and Citi is a bank in change. Are we in some kind of a dissipating battle of NII? Do you buy that, or have we oversold that?
I think maybe we've oversold that a little bit, but I do think there are differences by bank in terms of the NII trajectory. With JP Morgan, I would just keep in mind, though, the bar is really high. And I think the expectation was that they would increase their net interest income guidance. They kept the reported net interest income guidance at $90 billion for the full year. And remember, when they gave their guidance last time around, we were factoring in 6 rate cuts. Now we're factoring in 1 or 2 cuts. So I think there was a hope and an expectation that would move higher a little bit more than it did. So I think I would say JP Morgan has been fairly conservative and continues to be fairly conservative on their net interest income guidance. I think for some of the other banks, there are some different drivers here. I do think that that JPM, Citi, and Wells Fargo, for that matter, did throw a little bit of cold water on the view of net interest income into the back end of the year. But some of the other banks, though, they have somewhat different drivers. And I do think you're seeing deposit costs slow down. You actually did see that in the results. And you are seeing assets repriced, the fixed rate security, fixed rate loans repriced.
Before we let you go, because I got to get this in here. I mean, amid all this uncertainty, JP Morgan was hiring. It's not something most of the banks were doing. What did you make of that?
JP Morgan knows them best. I mean, look, JP Morgan is a tremendous franchise. They're going to invest for the long term. They're not going to get near, they're not going to allow, fluctuations in the near-term revenue outlook to change that view. I do think that there's secular pressures in terms of technology competition in the banking industry, and I think JP Morgan's strength is that they do have the capacity and the bandwidth to invest quite a bit through the cycle, and I think that just reflects philosophically how they think about the world.
Saul, really wonderful to have you on this morning. Saul Martinez of HSBC. Coming up, the IMF and World Bank meeting, as well as Netflix earnings, all on deck this week.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
It's Bloomberg Brief with Danny Berger and Manish Krani in New York. All right, let's get you set up for your trading week. Here's what's ahead. Former President Donald Trump's criminal hush money trial is set to begin in New York today. The IMF and World Bank spring meetings start in Washington and take place throughout this week. And Thursday, we're going to get Netflix reporting after the bell. Manis.
Yep, keep an eye on some of the micro movers. First up, we've got Salesforce. They are pursuing what will be one of the company's biggest ever deals targeting Informatica. That will boost its data capabilities. Thousands of Italians, keep an eye on Stellantis, are joining the picket lines. They're piling pressure on management in anticipation of new round of job cuts. And Tesla down 0.6%, laying off, we understand, 10% of the global workforce.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them. Did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger. But drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that. We'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the firing line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
We will still be talking about a situation where the U.S. economy is growing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your week started. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Let's take the temperature of things in the Middle East. Crude lower by 1%. WTI 84.79 on Brent crude right now, down by almost 1 full percentage point at 89.63. An unprecedented direct attack on Israel over the weekend. Iran lighting up the sky on Saturday night, launching more than 300 drones and missiles. Nobody killed, limited damage done in Israel. And Lisa, the word you hear over the weekend into Monday morning, one word: contained.
And de-escalation, and what types of efforts will there be to de-escalate on the part of the U.S., on the part of France, on the part of Germany? To me, the market isn't calm. To me, the market is not going to price in a geopolitical risk that has yet to transpire. But this is a market that is on edge with a new red line crossed. Iran has never before directly attacked Israel on its own soil. And even if it's not immediate retaliation, it raises the temperature in a new kind of way.
This, I think, is the consensus view on the street this morning. This from Citi. Iran's attack unlikely to lead to escalation in the near term. And I think we stress here, the near term. Key actors seem to suggest that there is no desire to escalate the conflict any further, at least in the short term. Again, the near term, the short term.
It's the near term, which is why you see the oil market starting to recalibrate. That risk we saw Friday before the attack going into it, although you saw a lot of a big price premium building into the oil market. And then come Monday morning, you saw that Israel and its allies were able to strike down 99% of these more than 300 missiles and drones. But to Lisa's point, the biggest takeaway from this weekend is a recalibration of these red lines, completely erased in terms of direct response on Iranian soil to Israel. Now in the future, when you look at potentially what could be retaliation for any movements in the Middle East, this is now an option that Tehran may use.
And the president very focused, and you've talked about this a million times, Anne-Marie, seemingly on defense and not deterrence. The president came out before these events and said don't. They did. And we're trying to work out what that means going forward from here.
They said don't, they did, and now the president is telling Israel to recalibrate and slow down in terms of a response. But for Israel, and their work cabinet has yet to make a decision, and if they do, they probably will not tell the press out in the open. But for Israel, this is existential. Iranians send more than 300 drones and missiles, including ballistic missiles, directly to their airspace. At some point, Israel is going to have to respond. It's a matter of when.
There's a lot to talk about through this morning. I think the first thing you want to have a look at when you wake up is what's happening with markets. So here are the scores for you. Equity futures are just about positive by 0.5% on the S&P 500. The bond market releasing some of that haven bid from Friday. Yields a little bit higher by 3 or 4 basis points, 455.84. And there it is, Bramo. Crude down by almost 1%, 84.85.
Crisis over. Everyone's calm. Everyone's not calm. This is really the key question as we get a slew of data, as we get Fed speak. How much do people have to start gaming out the idea of higher oil prices in a new kind of way? And it might not be imminent, but it is longer term. This week, there are 3 prongs. There's economic data, their earnings, and the Fed speak. Let's just get the Fed speak out of the way. We have Logan, Williams, Daly, Jefferson, Powell, Mester, Bowman, Bostic, and Goolsbee throughout the week. Curious to see how much they recalibrate, given the fact that we're seeing confidence coming in a little bit, but inflation expectations picking up. We're also going to get earnings. We have Goldman Sachs today, Morgan Stanley, and Bank of America tomorrow, and a smattering of tech later in the week, TSMC and Netflix. And then, of course, we do have economic data. We have the idea of retail sales that's coming out today. We have later in the week Beige Book and then jobless claims. And to me, the key question is going to be, how do you filter all of these types of events through the lens of the potential for higher commodity prices? To me, that's going to be a running theme underneath because of the geopolitical framing.
I think 3 things to watch this morning. 7:30, Lisa went through some of those issues for you. Goldman Sachs, those earnings coming out. Mike McKee catching up with President Williams. Look out for that conversation too, immediately after we get US retail sales. Coming up through the next hour or so, we'll catch up with former senior intelligence official Norman Rule following Iran's attack on Israel. Nadia Martin-Wigan of Svelland Capital on the response in commodities. And Andrew Balls of PIMCO saying US growth has hit its peak. We begin with our top story, Iran's first ever direct attack on Israel from Iranian soil. A war cabinet led by Israeli Prime Minister Benjamin Netanyahu is expected to decide on a response. The former senior intelligence official, Norman Rule, saying this: the US won't participate in a counterattack, but will insist Israel advises of the attack and that it will likely bring in US participation, if only for defense. Norman Rule joins us now for more. Norman, serious events over the weekend. I think we're all trying to work out whether this is a new phase for tension between Iran and Israel, or whether we just witnessed what some people might describe as a highly choreographed billion-dollar episode of skeet shooting. Which one is it?
It's a new Middle East. It's a Middle East in which Israel every day must wonder if some action might provoke an Iranian missile attack or drone attack on Israel's territory direct. And it also is a new Middle East in which Israel is now, in theory, open to do the same against Iran. The United States, Europe, the United Nations, and others will certainly not want this to happen, but by allowing Iran to conduct an unprecedented attack, which was certainly not just symbolic, you now have this new world.
The president reportedly, Norman, has told the leader of Israel to take the win. Take the win. What did you make of that?
Well, the president is correct in saying the Israelis have achieved an extraordinary victory over Iranians' arms and should pause and deal with the problem of Gaza, the challenge of Lebanon, before doing something that might escalate the region into a conventional war. All that's well and good, but again, if you're in the Israeli war cabinet, you have a serious issue. How do you deter Iran from doing this again? And that can't be put off too long, and that isn't something you do with a diplomatic note.
If the Israelis are looking at that, how to deter Iran from doing something like this again, what kind of a retaliation could we see, the scale of the retaliation Israel may take?
Israeli retaliation will likely be proportional. It will likely be limited. It will likely be something that is meant to demonstrate we can touch you in ways that hurt. And for that reason, I think Israel is also not looking for a conventional war itself. But this takes time to work out. And I think what you're looking at is a cabinet in Israel looking for that Goldilocks position, something that doesn't start a war, something that resets deterrence and allows them to focus on the issues that the Biden administration correctly addresses.
The Biden administration over the weekend went to pains to telegraph to the world that they do not want to see regional expansion of this conflict. They do not want to see a wider war with Iran. But what could the U.S. have done to then deter this attack instead of being in a position of purely defense?
Well, again, the White House is correct in doing what it can to contain a very fragile and turbulent situation. In theory, based on previous actions of the United States, it could have been a decision to move U.S. military assets closer to Iran, not because it's necessarily needed to conduct an attack, but to demonstrate to Iran that we might have been prepared to do something in that build-up period to deter an attack. But a lot of this also has to do with Iran's assessment of the U.S. willingness to engage in such a strike, whether Europe would join us. And I don't think the Iranians feel the Biden administration is seeking such a confrontation.
There were a lot of precedents set over the weekend, and it was really interesting to see not only that the U.S. backed Israel, but also the U.K., also Jordan and the other areas in the region that hate Iran more than they hate Israel. How does this set up the idea of what could potentially take place in terms of pressuring the region into some sort of peace agreement?
Well, there were a number of firsts this weekend, to include new weapons. Israel deployed its first naval Iron Dome. And you saw this unofficial coalition form of the United States, the United Kingdom, traditional partners, but also France, Jordan, and even Saudi Arabia. But this is a very ad hoc grouping, and it took a fair amount of diplomatic work. And I think we need to praise the Biden administration and particularly Central Command and NAVCENT for their work in building these partnerships. That's not always guaranteed in the future. And unless the administration believes the United States has their back, they won't be willing to enter into such formal entities.
Well, that's why I was going to push this forward to the idea of sort of freedom of the seas. You were talking about how we've seen the idea of trade really challenged. And then we're not even talking about the Straits of Hormuz and the fact that Iran went after a ship in that region and what this raises in terms of questions about the willingness to really curtail some of that transportation route. How much could this coalition go after to try to sort of reclaim some sort of freedom of the seas?
Such a coalition will not be effective unless it believes the United States is fully committed to deterring as well as defending aggression in the region. And the Red Sea example says that that's simply not the case. The United States and its partners have done a superb job defending and indeed degrading Houthi capacity. But there is no evidence that we're seeking to push this into Yemen in a way to deter Houthi decision-making. So unless you take that model and apply it across the region, if you're a member of the region, you're basically seeing that you're exposing yourself to retaliation by Iran and its proxies.
So Norman, let's finish there. What is the best way of influencing decision-making? What aren't we doing that we should be doing?
A multilateral approach involving economic and political isolation of Iran with patience and a willingness to take their tests of our fortitude has traditionally been the best approach. We just don't have such a coalition at present, and I don't see a lot of efforts to build one.
Norman Rule, thank you for your input this morning, sir. Always valuable. Former senior intelligence official, Norman Rule. The president said don't. They did. Lisa, we've talked about this for a number of weeks, a number of months now. US and allies have struggled to prevent Houthi, Iranian-backed rebels from disrupting the Red Sea. It feels like over the last year or so, the ability to influence Iran has diminished. It hasn't grown.
And when we talk about additional sanctions, you have to wonder, have the sanctions that have been placed on it really had any effect whatsoever? There are all sorts of questions going forward in terms of how far Iran's going to push this, considering that they did cross previously was believed to be a red line. Right now, the focus has to be, to some degree in this administration, prevent some sort of escalation that could cause oil prices to spike ahead of the election. That has to be somewhat on their minds.
Well, it's very difficult, though, for this administration ahead of a U.S. election, which is why they have a lack enforcement policy when it comes to Iranian sanctions that are on the books. And I think Norm got to that at the very end. It's economic coalition, meaning you have to pressure China to stop buying the more than 3 million barrels Iran is currently has in oil output a month. This is where it comes down to potentially that deterrence factor the U.S. could have been taking.
So far this morning, there is a belief that things are contained. We're looking at a bond market that's doing okay, yields are higher. Looking at a commodity market which is lower by 0.75% on Brent, 89.77. On WTI, we're negative by 0.8% at around about $85 a barrel. Let's get you an update on stories elsewhere. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. German Chancellor Olaf Scholz has begun his second visit to China. He's expected to say that Beijing has not acted on European warnings to end discriminatory business practices. Sources also say that Scholz wants to persuade Chinese President Xi Jinping to act as soon as possible to avoid EU tariffs meant to rebalance the trade relationship. Scholz is also expected to question Xi about China's support for Russia's war machine as the war in Ukraine continues. The Biden administration plans to award Samsung as much as $6.4 billion in grants to increase chip production in Texas. All of this is part of the U.S. efforts to really help domestic semiconductor manufacturing as it's grown in China and elsewhere in Asia. The money will also be used to expand Samsung's existing chip-making facility in Austin. And the 128th Boston Marathon kicks off today. The city thinks that it will get a $200 million economic windfall, which would be the largest for it since the pandemic. 300,000 runners will be competing with a title and a $1.2 million prize at stake. That's your brief, John.
Danny, thank you. Best of luck to all the runners a little bit later on this morning. Up next on the program, earnings season ramping up.
If the Fed doesn't cut rates, you could have a little bit of pressure on valuations, but how do you offset that pressure? By higher top-line growth and by higher earnings growth as well.
That conversation up next, live from New York City this morning. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crude this morning, negative by 0.8%. I believe so far, at least in the short term, that things are contained. We're down 0.8 to 84.95 on WTI. Equity futures bouncing back by about 0.5% on the S&P 500, following the biggest weekly loss of the year so far. Under surveillance this morning, earnings season ramping up.
This is not just a one-engine economy, but sort of maybe several things working in favor. So that's why we look, of course, to the U.S. to have some of the highest earnings revisions momentum, but also Japan. That's why we look to industrials, materials, consumer discretionary, semiconductors, of course, to have some of that upwards earnings momentum. If the Fed doesn't cut rates, you could have a little bit of pressure on valuations, but how do you offset that pressure? By higher top-line growth and by higher earnings growth as well.
Here's the latest this morning. Equity markets rebounding on the heels of a turbulent weekend in the Middle East as earnings season gets underway. And Witi Bahuguna of Northern Trust writing this. Earnings will support global equities, but potentially higher bond yields could weigh on already high valuations, underpinning our neutral stance within a multi-asset portfolio. And Witi, I'm pleased to say, is with us around the table here in New York. And Witi, good morning to you.
Morning.
See, there's a series of notes so far this morning. To what degree bonds are a challenge to valuations in the equity market? Can we just start there? Do you think we are moving back to that no-landing scenario for both equities and bonds?
For equities, at least it seems like that, given how strong growth has been. But for bonds, it's still very much an inflation story. So if you look at what moved rates this year, that was a reasonably substantial move in the 10-year. But if you break it down onto what drove that move up, it was still predominantly growth being priced higher and some backup in inflation expectations also. But it remains a growth story. As long as we don't see labor markets weaken, I think equities continue to do all right.
I've seen a lot of challenges to this rally. A lot of people don't like it right now. They haven't liked it for about 2 years, but they really don't like it right now. And it's potentially because they see earnings being unable to fulfill lofty expectations and the prospect of no rate cuts, the idea of higher yields in the face of higher commodity prices, et cetera. Are you on that same camp where you're kind of shifting to a more negative view just simply because of some of these overhangs?
Right. So, how long can, to Jonathan's question, the rate rise be digested by the equity markets? And I think as long as that growth momentum stays all right, markets will be okay with it. What's surprising, Lisa, is how it seems to digest any sort of geopolitical tension also. And that, I think, is really U.S. exceptionalism, right? Seems to be an island that's isolated from most of these events. Key for me is to watch what happens to oil and if oil stays contained, because that then seeps into inflation expectation, that then complicates the picture for the Fed, and then that makes you wonder, will any further rate hikes will be digested?
This is important. Is that basically a more important gauge to watch right now, even in some of the inflation data or the Fed rhetoric? It's really oil prices and how much they respond to the geopolitics.
Oil prices and labor market. Two sides of the spectrum on two-tailed risks that I'm watching. So the one-tailed risk is that labor market starts weakening. This enormous 400 or 500 basis points of tightening that we have seen over the last 2 years finally comes to bite the markets, and we see recession risks come into the forefront. And the other is oil. Inflation expectations seeps into broader CPI numbers, and then Fed's hands are tied. So two-tailed risks. But for the moment, we're staying the course, very neutral. Do not want to miss out on the strong equity momentum rally either. But at the same time, not a time to load up on duration either, because those are tail events.
When you look at oil, though, and if, say, you park geopolitical risk, what does the supply and demand picture tell you? Because right now, the world does seem still pretty flush with enough supply.
There are lots of sanctions, and it's kind of hard to figure out who's breaking those sanctions and where the oil is going. But the demand picture is not a bad growth picture, because the demand picture means people want oil because economies are growing. Even the economies across the globe are looking for oil. So that's not really a negative if it's coming through the demand side. It becomes negative if it's through the supply disruptions and all the stuff that, again, markets seem to have digested that pretty reasonably well over the last 6 months also.
And your other concern, of course, the labor market. And you talk about immigration in your note. How do you prepare for, say, a 2025, 2026 labor market if immigration policy could be drastically different?
Yeah, that is a wild card. So far, the labor market has had a positive boost from the immigration supply. That's borne out in data, and that's kept wages contained. I mean, they're not contained, they're still around 4%. Fed would like to see that go lower, but so far that's been the support. And elections are potentially a wild card. We don't know what happens then, and that's not something you can prepare very well for again. So I go back to saying, stay the course, stay invested, do not panic on moments like this.
Staying the course appears to have changed from day to day, particularly with whether to go to bonds for risk mitigation characteristics or not. Can we talk about that just a little bit? Friday felt like that classic risk-off, earnings-led risk aversion with a layer of geopolitical risk going into the weekend, and treasuries rallied. But the relationship between stocks and bonds has been so inconsistent, as you know, over the last few weeks. What's your understanding of what bonds do for you in a multi-asset portfolio?
I think there's still a perfect hedge for a day like Friday. So you do want to have duration, but you don't want to be overweight duration at this point, Jonathan. So we are not overweight duration, we have duration, because if this geopolitical risk does become real, or for the first tail risk that I talked about, which was recession coming back into the forefront, you'll see treasuries give you enormous protection in a multi-asset portfolio.
It seems like a lot of people are saying they're hamstrung in this sort of aggressively neutral area. I think that was Sebastian Page who said he was aggressively neutral, and it feels like, there's sort of this trepidation of what you don't know. How do you hedge? What's the tail risk? Because you look at oil prices and say, if they cross $95, say, I'm sure you have your bogey, I'd love your take on that, then we need to have some aggressive protection.
I actually don't anchor on a single price number. It's really the compendium of all the data that we are looking at. And I love that expression, aggressively neutral, but I would say we are sort of like passively neutral, not very aggressively neutral, because, to us, a lot has been priced in terms of valuations in the equity markets. And really what I'm looking for is broadening of equity markets. And that, Lisa, we haven't seen. There have been sparks of it in March, but it hasn't really followed through across all the portfolios. So we haven't seen China rally massively. We haven't seen small cap it's still been a US large cap growth trade.
Well, small caps got absolutely battered last week, didn't they? And Witty, great to get your thoughts on the programme. Appreciate it. And Witty Bahugunna there of Northern Trust. Just getting some breaking news for you. It comes from Electrix. A report on Tesla that they will reduce the global headcount by more than 10%. Elon Musk cited as saying duplication of roles and job functions in certain areas as the reason for cuts. Again, this is based on reports. The stock is down by 0.5%. But if you take that 10% and you assume it applies company-wide, at least we're talking about 14,000 employees.
Just a little more color here in terms of the email that was seen by Electric. This from Elon Musk. As we prepare the company for our next phase of growth, it is extremely important to look at every aspect of the company for cost reductions and increasing productivity. This sounds like a car company. This doesn't sound like a hyper-growth tech company. This sounds like a company that has been beset with a lot of questions around how many deliveries they can really make to China, given some of the low-cost options and given some of the geopolitical pressures.
Yeah, well said, Lisa. Without a doubt, right now, this is a company, Anne-Marie, confronting a really tough industry. And that industry is the auto market in general, and more narrowly, it's EVs, which have struggled over the last few months.
Absolutely. We're seeing this glut in the EV market a slowdown in terms of sales, especially for Tesla in a key market of China. And you're seeing this competition with Chinese rivals like BYD continues to cut prices. And Elon Musk, to Lisa's point, what he's saying here is cost reduction. They are trying to find ways to trim on the margins to make sure that they are profitable.
We'll look for some confirmation, of course, from Elon Musk himself or from the company Tesla. The stock is down by 0.5, call it 0.6% lower in the pre-market. Coming up on this program, oil striking off tensions in the Middle East. We'll catch up with Nadia Martin-Wigan of Svelland Capital. She joins us very, very shortly. As you wake up this morning looking at crude lower by close to 1%, Brent down to 89.66, WTI Bramo 84.83.
Is this calm? I mean, this is what I woke up saying. Is this calm? Is this the market taking a deep sigh of relief? Or is this a market saying, there's nothing we can trade on, so we have to just basically go with what we see, which is it's not escalating right now?
I'm not going to attempt to read the emotions of people as they wake up Monday morning, but I will say I think the big takeaway seems to be that it is contained for now, and we wait for one thing, which is to see what Israel's reaction to this is going to be, which is why we're all looking forward to catching up with John Kirby a little bit later this morning. That conversation about 2 hours away. Live from New York City this morning. Good morning to you all as we kick off a brand new trading week. A little bit later, US retail sales.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Live from New York City, welcome to the program. If you are just joining us, equities bouncing back just a touch, up by 0.4% on the S&P, on the Nasdaq 100 up by 0.5, coming off the back of the biggest weekly loss of the year so far. In fact, the biggest weekly loss, I believe, going back to the end of October. Small caps last week absolutely punished. The Russell up this morning by 0.2%. The relative outperformance of the Nasdaq 100, Lisa, the big cap tech story versus the small caps, pretty pronounced through last week.
That just speaks to the haven trade and that somehow big tech is still considered the haven regardless of some of the rate concerns. Lori Calvasino put it really well of RBC Capital. She said geopolitical concerns are spiking at a time when stocks already seem due for a pullback. The rotation trade has just gotten a lot more complicated.
Let's get to the rate concerns. Let's turn to the bond market. 2-year, 10-year, 30-year, double-digit moves across the yield curve on a 2-year and a 10-year last week, and some new levels to talk about. New highs for the 2-year, 5% for the year. New highs for the year on a 10-year, 4.58.86, and we're just short of them right now. We're up by 4 basis points on a 10-year, 4.56.66, and Lisa, the front end of the curve, 4.93 on a 2-year, and note after note this morning from Morgan Stanley and Mike Wilson to others as well, all talking about the same thing, the challenge to the equity market from these numbers right here.
And to take it a step further, all of these people talking about the fact that possibly we are looking at bonds not being the haven trade that they once were, and you ask us of Anwidi, and I'm glad that you did, this question of can we look at bonds in the same kind of way in a portfolio if we do see this potential inflationary shock underpinning an already significant concern about a commodity shock?
Is that why more and more people are starting to look at gold? Let's switch up the board and go to the commodity market. AMH, let's talk about crude. Down by 0.8 on Brent, 89.73. Down by 0.9 on WTI, 84.88.
This is because the immediate escalation, the immediate concerns of damage are now in the rearview mirror. You cannot say that the geopolitical risk has gone away, given the fact that Israel is likely going to be retaliating, but at the moment it has all been contained. This was a barrage, a huge assault on Israel, and they will defend it off. And that is what you see in the oil market. Take a step back, a breather than what we saw on Friday.
So words you're going to hear a lot this morning, contained. Under surveillance this morning, Israel's war cabinet led by Prime Minister Benjamin Netanyahu expected to decide on a response to Iran's first ever direct attack on the country. A meeting of G7 leaders urging both sides to avoid further escalation. Iran launched hundreds of missiles and drones at Israel, yet nearly all were intercepted by the Iron Dome or allied forces. Now, Lisa, how long we'll be able to say that word contained, I don't know. And that's the risk around some of these stories.
Especially because, as we heard from Norm Rule, this has been a lot of unprecedented Israel on its ground, but also the first time you've seen a coalition that has been pulled together from Middle East and as well as Western allies. Here's the key question. How does a market price something that is so ambiguous, that is so unknown? You don't, because you always get your face ripped off. So right now, it's hard to say that this market is really digesting what could be a potential huge geopolitical risk. It's just maybe there's a new risk premium that really sets a floor, as you've been saying, under the price.
I think the biggest takeaway from this weekend, and Lisa, you talked about it, is the red line has been evaporated. Glass has been broken. You cannot put that back together. Iran attacked Israel directly on their soil. This is something now we can potentially expect in the future.
Especially when the president is saying take the win. You know, some people might say this demands a response from Israel, but the president of the United States is saying take the win.
Well, this is going to be the scale that also Israel is debating. Individuals who say, like the President of the United States, slow down, take this win, look at the fortitude we showed, and then others like Itamar Ben-Gvir saying, in order to create deterrence in the Middle East, the landlord must go crazy. This is what we're dealing with right now in terms of how we decide and look at potentially how Israel's going to respond.
In just a moment, Nadia Martin-Wiggins is going to join us to talk about the commodity market. Look out for that conversation. I just want to shift gears briefly and talk about Apple. Continuing to face headwinds in China, iPhone shipments sliding 10% in the March quarter, according to market tracker IDC. This marks the steepest decline for Apple since COVID lockdowns back in 22. Apple is facing growing competition from domestic producers like Huawei. The stock is down by 1.2% on the session in the pre-market. Year to date, it's had a difficult year. We're still down by close to double digits.
It relates to the Tesla story, too, because both of them have a really significant domestic market in China. And it speaks to something that Peter Scheer of Academy Securities, who's coming up later in the show, has been talking about a lot, which is that China is increasingly a competitor, not necessarily just a supplier and part of the supply chain. They are looking to try to get their products out. And the key question for us is, how does a company like Apple diversify away from an area that is such a huge consumer base, both with respect to buying, but also with producing said phones? This has been a perennial issue. And frankly, it's the same for Tesla.
Stock is down on Apple by a little more than 1%. Lisa mentioned Tesla just moments ago, a report coming out suggesting that Tesla is ready to cut 10% of its global workforce. More on that story a little bit later. Elsewhere, global metal markets reacted to new sanctions on Russian supplies. Aluminum surging as much as 9% before parent gains. The restrictions put in place by the US and UK late Friday are aimed at Russian metals, including nickel and copper. Meanwhile, crude markets are easing, expecting calm after Iran's attack on Israel. Joining us to discuss is Nadia Martin-Wiggins of Felon Capital, saying, quote, to assume the war is now over is premature, so we would not be sellers of oil at $90 a barrel. Nadia joins us right now. Nadia, let's talk about it. So potentially a new floor for crude. Let's talk about how high that ceiling might be. How high is that ceiling now?
Well, it's great to join the show. I think immediately we saw that on Friday we traded up to $92 a barrel before the close, before coming down. That's a first target. We know that there is a lot of call option length at around $95 a barrel. So that's the next question, is whether we meet that price in the coming weeks before expiry.
Nadia, can we talk about the potential for retaliation from Israel? There is a sense this morning, and I stress in the near term, we keep hearing this word around this table, contained. How contained do you think things actually are, and how do you think this commodity market would respond if we began to see headlines suggesting that Israel is ready to retaliate?
Thus far, we would characterize market reaction as pricing in the Goldilocks scenario, that things are contained, as you say. We believe that if things were to occur in terms of more tangibles, that Israel would, how a counterattack would come, or if we saw additional attacks on the shipping industry, right? There is no indication that the Houthis are stepping back. And as early as last week, there were discussions that maybe we would reach a permanent ceasefire. Right now, that doesn't seem to be the case. So any sort of attack within, especially the Straits of Hormuz, that would absolutely impact the oil market and the shipping markets immediately.
Nadia, if we were going to see, and I know Congress in the House of Representatives, they want to see this, a stricter, at least the Republicans, a stricter enforcement on Iranian barrels. How much enforcement would actually take some of that crude off the market?
Yeah, so we've seen that since 2019, Iran's crude exports have risen from around 500,000 barrels per day to 1.6 million barrels per day, because the U.S. is largely turning a blind eye. So that's at least 1.1 million barrels of oil that could come off the market and could be supplied instead by Saudi Arabia. And we're still in the same supply-demand balance as before. That would also impact the shadow fleet, because it would mean that actually crude would have to be transported by the ships that are VLCCs and so forth that are involved in the normal market. So that would lead to a price appreciation on the shipping side as well.
When you look at potentially a place for OPEC to step in, a lot can happen between now and June 1st when the group is set to meet. At what price point do you think they'd be willing to add more supply?
Well, in the mid 90s, upper 90s, they would absolutely be forced to. They don't want to see $100 oil, according to themselves in recent interviews. So then they would really be compelled to step in. And that's where, when we see those tightening balances, we didn't see balances build or inventories build in the first quarter. The IEA reported last week that we are at a 5-year low in terms of OECD company stocks as of the end of February. There's going to be a lot of pressure on them to increase production when refiners come out of maintenance. And in China, that comes in June. In Europe, that comes in June. So that really coincides with that OPEC meeting to provide more crude to the market so refiners can run as they should to meet demand in the second half of the year that we see much higher than what the IEA put out on Friday at 1.2 million barrels per day year-on-year growth. We think it's closer to 2 million barrels per day year-on-year growth, and that includes some growth in U.S. oil demand.
Just can you give us a sense of how much potential ammunition the United States has to counter some of this with the Strategic Petroleum Reserve, given the fact that I'm looking at oil prices about the highest going back, gasoline prices, I should say, gasoline prices in the United States highest going back to October. Heading into the busiest driving season, heading into an election where gas prices sometimes win it or lose it.
Yeah, in our view, it's premature for a U.S. SPR release. Probably they would release 500,000 barrels per day starting 4 months before the election, 1 million barrels per day 2 months before the election. So they really want to hold that ability to easily throw in as much market oil as is necessary to the market until they actually see a supply outage in the Middle East, or until we are much closer to the election, because we're still so many months away that they don't want to use up that bullet before we're close to the election.
Nadia, going back to something that you said at the very outset, that we're pricing in Goldilocks, is there any risk premium baked into the price as is that you can identify that wouldn't be there, where prices would be substantially lower if there wasn't this pressure coming from the Middle East?
Well, there is some priced in, right? We've seen the net length in the oil market rise quite a lot, and in the gasoline market, it's at a 4-year high. So there's definitely some priced in. On the other hand, we have a bullish view going into the rest of the year. So it makes a situation difficult to say that, okay, maybe people are putting on this trade a little bit earlier because they see the demand is coming, but right now there's a heightened risk. So some have floated $5 risk premium. That's maybe possible, but we would really have to see a permanent ceasefire come out of this in order to see, I think, prices really trade down. And then the other one to include in this is, of course, the situation in Russia. We see up to 1.3 million barrels per day of refinery capacity being impacted by the fact that these Ukrainian drones have, had 12 successful strikes on refineries. So, we can't forget that right now the market is assuming that everything will be up and running perfectly by mid-April to mid-May. But what if that takes longer because Western companies aren't involved in refinery maintenance in Russia? So that is another element that all is not at ease there. So that's an additional element of political risk that I think is a little bit underappreciated right now, because the focus is on the Middle